So you are now in live.
Yeah. So can I start?
Yes, sir.
Yeah. So welcome, students. Good evening to all of you. So we'll be continuing with the third day of marathon session, and it's module 3. It's like we're going to cover one module each day, and we're in the final module. So we have already covered the basics, the residential status, all the heads of income and other things. So now after the heads of income, it's important that we learn about clubbing. So when you say clubbing, there are certain types of clubbing. So when is clubbing applicable? Basically, if you actually look at it, when it comes to individual, there's a slab rate. So I could take advantage of the slab rate by splitting my income between my family, so that on an average, I make low tax. I pay low tax. So basically, the clubbing could be I'm transferring the income without transferring the asset, or I could be there is an income that is arising from a revocable transfer. So that's the second thing. Third is spouse income. When should it be clubbed? Income of son's wife. So they're not also leaving the daughter-in-law concept. So income of son's wife, when should be clubbed? And finally, minus income. So this is what we'll be learning about the as far as this clubbing goes. So first thing that we'll understand is transfer of income without transfer of asset. So the example is like a person owns an asset, but the tenant pays rent to the spouse. So when this happens, basically the asset is owned by someone, but the rental belongs to someone. So this is called clubbing, where there is a transfer of income without transfer of asset. So basically asset is owned by a person, but the income is transferred to another person. So if this is identified, it will be clubbed in the hands of transferor itself. So the transferor is a person who basically is involved here. So this person needs to pay tax, though the rent is received by this person. In house property, we said you need not be the owner of the house. But in this case, though you're not the owner, the income will be clubbed in the hands of the other person, because this person is the owner, and the intention of transferring this is purely to avoid taxation. So basically, what is mean by transfer? When you say transfer of income, it could be anything in this, any arrangement. So you need not have a written agreement saying you will receive the rental. Anything and everything could be treated as transfer. So the only condition is asset is owned by someone, rental is received by someone. So this is the only concept that we are referring to here. So the transferee is the one who's receiving the income. The next concept is called revocable transfer. So revocable transfer is basically the word revocable. So we need to understand, of course, what exactly is the word revocable. So this is discussed between section 61 to section 63. Section 63 is the definition section. So it defines revocable transfer. So it says, what do you mean by revocable transfer? At any point in time, if the transferor, that is the original owner, if at any point in time, the original owner can get back the rights in whole or any part. So that's the keyword. So basically retransfer directly or indirectly the whole or part. So at any point in time, I'm going to get back the power or get back the ownership. So today I'm transferring to someone, but it's not a permanent transfer. I'm not selling. I'm transferring the right temporarily. So in future, I may get back it. So when there's a chance of getting it back, it's called revocable transfer. Of course, the reverse is irrevocable. Earlier, it had a limit, that is 6 years. That is a very old, March 61. None of us were born. So basically, currently, it is the lifetime of the beneficiary. So if I am the transferor, lifetime of me, the person who's benefited. So if the lifetime of beneficiary, it will not come back. Then it is called. So not revocable during the lifetime of the beneficiary or at the lifetime of the transferee. So in this case, if that is the case, so if I am the owner of the asset, I'm transferring it, I'm giving the right till that person is alive. So that becomes irrevocable. So irrevocable is you don't get back the power. So the benefit is discussed here. What kind of benefit? So when you say transfer, some type of benefit is transferred. You could transfer the income, or you could transfer the asset, or you could transfer the facilities, whatever it is. But there is some transfer. So this transfer is basically called as direct or indirect benefit. So whatever could be transferred, the transfer, when it is irrevocable, if the transfer receives direct or indirect benefit, then though the transfer is irrevocable, when the power to revoke, the transfer arises. So basically, even in irrevocable cases, if benefit is proved, if the benefit is going to be derived, then that becomes automatically revocable. So basically, there are two types of transfer, revocable and irrevocable. And in case if the transferor receives direct or indirect benefit, then even in that case, what happens is the transfer automatically becomes Even if it is irrevocable, it will be treated as revocable. So benefit is nothing but this will be treated as revocable transfer. So that is what we are calling it as. So there are only two types of transfer, revocable, irrevocable. The third one is if some form of benefit is being derived to the transferor, even though it is irrevocable, it will be treated as revocable. And next is income arising of spouse. We'll take a small example. There is a couple, Rahul and Pooja Rahul. The Rahul is owning substantial interest in ARC Private Limited. ARC Private Limited is employing Pooja as the finance manager. And in this case, whatever salary is derived by Pooja has to be clubbed in the hands of Rahul, because the employment given to Pooja as finance manager is just because Rahul has substantial interest. Of course, if it sounds reasonable, no, it doesn't. Because what if Pooja becomes a chartered accountant? What if Pooja is a chartered accountant? She's of course eligible to be a finance manager. So in that case, there is no clubbing. So when there is skill available, and the employment given is basically out of the skill set, then it is not clubbed. If there is no skill, then automatically it has to be clubbed. So provision does not apply when there is skill set that is evaluated. So when it's CA Pooja Rahul, then it's not clubbed. When it is just Pooja Rahul and there is no skill set, still appointed as finance manager, then the income should be clubbed. And what is substantial interest? Substantial interest is basically 20%, whatever we have seen earlier. When both of them have substantial interest, whosoever income is higher, it will be clubbed in their hands. And the next concept is transfer of asset. Earlier we saw remuneration being transferred. In the first situation, we saw transfer of income without transfer of asset, But now what we are going to see is income arising to spouse by transfer of asset, which means I'm gifting my spouse without any consideration. So in this case, what happens? So in house property, if it is related to house property, if the transfer of house property is without adequate consideration, then automatically, though it is transferred to the spouse, the transferor will be treated as deemed owner. So this is available in house property. So this provision is actually applicable in house property, but this provision is not applicable when it is paid for living apart. So if it's divorce settlement or something, then it will not be clubbed. So this clubbing happens only when the relationship is live and it is gifted to another person without adequate consideration. Automatically, the income of spouse will be transferred and will be taxed in the other partner's hand. And what about any other asset? You are transferring directly or indirectly. Income arising from transferred asset will be taxed in the hands of transferor. Very simple. So I have transferred asset. The asset is mine, but I have not got any adequate consideration. I have just transferred it. Whatever is income is derived from that asset, I am only taxable. I am only liable to pay tax, not my spouse, so not my partner. So that's what it is about. So, and one more thing is adequate consideration does not refer to love and affection. I love my wife. I'm very affectionate. So that is the equivalent consideration for gifting. She cooks every day. She takes care of every day. She also earns. She is superior to me. Whatever be the reason, that is not the reason. When you say consideration, it should be in the form of money and nothing else. So that's what you're actually calling. And sometimes what happens is you don't transfer the asset to the spouse, you transfer to another organization as let's say a trust or something. That trust will indirectly for the benefit of my spouse. So I'm transferring to a trust, but what is the purpose of the trust? Trust is to give the benefit to my spouse. In that case also, it will be clubbed in my hands. So that is about income arising to spouse. So we saw remuneration, we saw transfer of asset. Now we are seeing in use of asset. When you say use of asset, it's like giving money. Money is also a form of asset. Let's say I'm giving some money to my spouse and she's earning out of it. That income needs to be clubbed in my hand. But income from transferred asset alone should be clubbed. If I'm giving 5 lakhs, whatever is earned out of that 5 lakhs should be clubbed in me. But subsequently, let's say a 5 lakh was converted into 6 lakhs in 1 year period. The additional 1 lakh is called accretion. If she is reinvesting that 1 lakh, that will not be clubbed. So investment from income will not be clubbed. So that's what they are calling it as income accretion. So income accretion is what means only the original income is clubbed, not the subsequent investments will not be clubbed. So a clear example is like the cow and calf. You're only responsible for the cow, you're not responsible for the calf. So whatever the cow will yield, you're supposed to pay tax. Whatever the calf yields, it is not out of your money. So investment, transferred asset invested in business by business. So basically, you are investing in a business. So let's say the spouse is running a partnership firm. You are giving some money that is being put into money. let's say the total investment is 10 lakhs. Out of that 4 lakhs, out of 10 lakhs, 4 lakh is your money, 6 lakh is your spouse money. Automatically, what will happen is whatever is the proportionate profit of this 4 lakhs will be taxed in your hand. So the proportionate capital must be clubbed based on the 1st April date. So whatever was available in the 1st April, whatever is your money, whatever is your spouse money, your proportion, you need to pay tax. Spouse proportion, spouse will pay tax. So that is what you're actually calling it as clubbing of money. So that is your investment. And then moving on, income arising to spouse or daughter-in-law. So we'll just summarize this provision. Whatever we discussed for spouse is also applicable for daughter-in-law. So in detail, what did we discuss? We discussed about 3 things. First is asset transfer. Income from such asset should be clubbed. Accretion should not be clubbed. So these are the 2 things we understood. Whatever income from such asset should be clubbed, accretion will not be clubbed. If it is an investment that is giving money for partnership firm or share capital or something, the proportionate of such investment should be, we discussed about 4 lakh and 6 lakh. Profit will be divided into 4:6 ratio and will be accordingly paid tax. And what if I'm transferring an asset to another organization, a trust or something, but for the benefit of the spouse or the daughter-in-law? In that case also, it will be taxed. It will be taxed in the hands of, the transferor. So in all these cases, whatever we discussed for spouse is also applicable for daughter-in-law, but for the remuneration. Every other provision is applicable equally for both spouse and daughter-in-law. So that is about your spouse and daughter-in-law. So this is all about your income. Apart from this, then we said there is minor income. So minor income, first thing we have to understand whether the minor income is skill-based. When you say minor income is skill-based, typically minor income, when you say skill, we'll take example like Pragyananda or Blidian Nadaswaram, who's a keyboard player, or Pragyananda, who's a chess player. Let's say till they achieve that 18 years old, they are minors. So whatever they earn is out of their skill. They know to play keyboard, they know to play the chess. So it's out of skill. So if it is based on skill, it is taxable in the hands of minor. If it is not based on the skill set, then we need to see whether marriage exists with respect to the parents. If marriage exists, either parent, whosoever is having higher income before including this minor income, that income needs to be clubbed. Otherwise, the parent who's maintaining the child needs to pay the tax also. And this, once you have started following in one particular year, you need to follow this for the subsequent years, unless the AO comes and say that this is not how you need to tax, you have to reverse the situation. So till that period, you have to follow this and say that it is only taxed in the person's hand who has higher income. So that's what it is about. And whatever, when a minor is disabled and covered under section 80U, then it will not be clubbed, because 80U is a section where you claim deduction, for your own suffering, So the minor child is suffering from disability, the minor will be claiming 80U deduction. So for such person, the income will not be clubbed. Clubbing provisions are also attracted in case of married minor daughter. So it doesn't matter whether the daughter is married or not, it is still clubbed. And how much is the exemption available to you? 1,500 per minor child can be available. And this is not available in the new tax regime. And one last thing we'll understand is called as cross transfer. So when you say cross transfer, typically what you mean to say is, when you say cross transfer refers to situation where I am not transferring to my spouse, I'm transferring to my brother's spouse. So in our example, A is transferring to A's brother's spouse, 1 lakh, and B is transferring 1 lakh to Mrs. A. So B, that is A's brother is transferring to Mrs. A. This is called cross transfer. So this is also called as clubbing only, but only when identified. These things, unless you tell income tax might not know. It is very difficult to understand independently. So unless there is some strong evidences which has been identified, it cannot be generally understood. So these things, clubbing is basically what the tax officer accepts, agrees, and communicates to the income tax officer. So, but in these situations, usually it must be clubbed. So in these 5 situations, clubbing is applicable. The next section that we'll be seeing is Chapter 6, which is called aggregate of income, set off and carry forward of losses. So of course, I'm going to convey this in one single slide. Okay, I'm going to convey this in one single slide. There are three types of losses. First is set off, and then you have carry forward. So when you say set off, it has inter-source and inter-head. Inter-source, inter-head. And in other situations, subsequent year, it will be called as carry forward and set off. In the year of loss, it can be either set off as inter-source or inter-head. Inter-source is within the same source. In my table given below, the green boxes is called inter-source. And inter-head is within each head. So like house property adjusted with salary is called inter-head. And what happens in the subsequent year is also discussed. So this table, what is this table saying? So these are all the losses and these are all the profits. So if you have a house property loss, you can adjust with all. And there's a small asterisk mark, terms and conditions like in your advertisements. This asterisk represents the maximum that can be adjusted is only 2 lakhs. The maximum that can be adjusted is 2 lakhs. So out of this entire house property loss, the maximum that you can set off with the other heads is 2 lakhs. So it is allowed inter also. It is allowed inter source also, inter head also. What about PGBPS? PGBPS stands for speculative. So when you say speculative, it is basically transactions where there is no delivery. For example, intraday trading. What do? I buy today morning, I sell today morning. Intraday trading is in stock market where I'll buy a share today morning, I'll sell it today evening itself. So technically, I am not a owner of shares even for 1 day. So which means my name will never get registered as a shareholder. So this is called intraday. So which means there is no delivery. Such incomes are called speculative. So speculative businesses, what happens? It cannot be adjusted. Loss from speculation cannot be adjusted with any other head. It can only be adjusted with speculative. So speculative loss only with speculative business. 35AD loss only with 35AD. What is 35AD? We saw yesterday specified business. We saw some around 13 business from cold storage business to infrastructure business. So if it's one of the business out of this 13, then we said capital expenditure can be claimed as 100% deduction. So such business, which is called as 35AD business, that is your specified business. So such business loss can only be adjusted with such business profits. If it is any other business, it can be adjusted with any heads of income, other than salary. So it cannot be only adjusted with salary, it can be adjusted with everything else. And these red ticks are called inter-source. Your regular business loss can be adjusted with speculative profit, specified profit, any other business profit. So the only thing that it cannot be adjusted with only salary, it can be adjusted with everything else. What about short-term capital loss, long-term capital loss? Short-term capital loss can be adjusted with both short-term capital gain and long-term capital gain. What about long-term capital loss? It can be adjusted only with long-term capital gain. It cannot be adjusted with short-term or any other heads of income. So short-term capital loss can only be adjusted within short-term and long-term capital gain. It cannot be adjusted with any other head, house property, business, any other head, it cannot be adjusted. Long-term, not even inter-source. It can only be adjusted with long-term capital gain. So these three businesses, 1, 2, 3, this is also not available for inter-source. 3 businesses, specified, 35AD and long-term capital loss. These 3 cannot even be adjusted with inter-source also, it cannot be adjusted. And finally, horse race is also can be adjusted only with the horse race. So this is also the 4th item. So these 4 items is available only for inter-source is also not allowed. It is only within the same source. It is not even inter-source. These 4 at speculative, 35AD, your long-term capital loss and horse race. These 4 losses cannot be even adjusted with the inter-source also, inter-head also. So that is your loss. And what about carry forward? Before going to carry forward, of course, we need to understand the order. If you are having a PGBP loss, first preference goes to current year depreciation. Next to current year scientific research and family planning. Scientific research is under section 35. Family planning is under 36. So these two can be claimed current year. With the balance profit, I can adjust any brought forward losses. After adjusting all these three, then if I have sufficient profit, I can go to unabsorbed depreciation. If I still have profit, I can go to unabsorbed scientific research expense. If I still have, I go to unabsorbed family planning expense. So this is the order of set off for PGBP. So that is first current year depreciation, current year scientific research, current year family planning. That is the first order. Then brought forward business losses. Then you go to unabsorbed depreciation, unabsorbed scientific research, unabsorbed family planning. So that's the order. So that is the order for claiming your PGBP. And what about carry forward? Generally, it is 8 years. House property, as we said, first year you can only adjust up to 2 lakhs and the balance can be carried forward for 8 years. PGBP speculative, it can be only carried for 4 years. However, there is no limit for unabsorbed depreciation, scientific research, and family planning. So irrespective of the business, this is always unlimited years. So the only limit is with respect to the regular business loss only. Specified business, that is 35 AD, has no limits. Only condition is it can only be adjusted with another 35 AD. What about PGBP? That is other PGBP, 8 years. Again, no limit for unabsorbed depreciation, scientific research. What about short-term capital gain and long-term capital gain? Both are eligible for 8 years. What about horse race? 4 years. So horse race and speculative. Horse race and speculative is 4 years. Rest are all 8 years. What doesn't have years? Your specified business under section 35 AD, unabsorbed depreciation, scientific research, and family planning. So these three does not have any limit. So there is no limit for these things. Only condition is when you are carrying it forward, subsequently in the year that you are carrying it forward, it can be adjusted only in the same head. That is, business can be adjusted only within business, house property within house property. So there is no interhead. Interhead is not available subsequently. It is only within the same head or the same source only. But unabsorbed depreciation, it can be adjusted at any other head other than salary. So the only head that unabsorbed depreciation cannot be adjusted is salary. So anything related to business cannot be adjusted against any other head of income, not even with salary. That is, your unabsorbed depreciation can be adjusted with anything else, but not with salary. So that's the only thing that you can. The only condition is it cannot be adjusted with salary. There are no other conditions. And that is all about set off and carry forward. So I have completed set off and carry forward in 3 slides. So with that, we are done with set off and carry forward losses. The next chapter that we'll be discussing about is deductions, chapter 6A. It's one of the most important topics as far as your examination goes. The set off carry forward loss, sometimes you might have a 6 mark or a 4 mark question independently only about set off and carry forward loss. But I've made your life so simple. Trust me, I've made your life so simple. The entire set of carry forward, if you understand these 3 slides, it is perfectly fine for sorting out your examination. I'm not giving a professional advice, I'm giving you an examination advice. So for examination, these 3 slides are more than sufficient. Moving on to the deductions under chapter 6A, that is which is covered under chapter 7. We'll move on. So of course, what exactly deduction is about? Deduction is something which can be claimed from your gross total income. So there is something called exemption, which means it's not at all part of total income. So exemptions are discussed in section 10, but deduction is something that is from your gross total income, you calculate. From your gross total income, you calculate chapter 6A. So that is what it is about. And generally, the deductions are divided into various bases. First set of deductions are called as payment. When you pay, you claim deduction. When you pay, you claim deductions. And next set of deduction is called on some incomes. On certain incomes, you claim deductions. Certain incomes, you claim deductions. And certain things are specifically for income from other sources, like your savings bank interest, your fixed deposit interest, specifically for income from other sources is discussed in heading CA. and everything else is covered in heading D. So we are going to understand based on these four concepts: payment basis, income basis, IFOS basis, other basis. Only we are going to understand the deductions under these four categories. We'll start with payment basis. We'll start with section 80C. So 80C, C stands for contribution. That is, I'm contributing some money. I'm contributing some money into something. I might be contributing to LIC. I might be contributing into specified mutual funds or specified deposits or something. So these contributions, so C stands for contributions. The first thing that we are going to discuss about is called LIC premium. So the premium that you're paying for LIC is claimed as deduction, if such LIC is covered under Rule 1010D. Section 1010D. So Section 1010D says, that is read with section, RWS is read with section. Section 10, Clause 10D says, if it is relating to a life insurance premium, please understand when was your policy taken. Was it taken before 2012, or it was taken between financial year 12-13, or it was taken from this date, from 1st April to. So split it into 3 dates. So when was your LIC policy taken? When was your LIC policy taken by you? If it was before 2012, very old policy, then automatically it is allowed as a deduction if premium paid is less than 20% of ACSA, that is actual capital sum assured. So if my premium paid is less than 20%, up to 20%, let me not say less than, up to 20%, then I am eligible for claiming deduction. Otherwise, I am not eligible. So it is restricted to 20%. So up to 20% of premium only I can claim as deduction. I cannot claim anything above that. So if you have paid 25%, what is eligible is only 20%. But if it is financial year 12-13, it is 10%. It is 10% of minimum sum assured. What is the difference between actual capital sum assured and minimum sum assured? Actual capital sum assured is one sum assured. When the policy has only one sum assured, you say actual capital sum assured. When you say minimum sum assured, it means some of the policies will have varies sum assured. First 5 years, your sum assured is 2 lakhs. Next 5 years, it is 4 lakhs. Then it is 10 lakhs. So if you're having a varied sum assured, then your basic minimum sum assured will be counted. So when you have several different sum assured for the same policy, the minimum sum assured will be taken. Of course, whether you'll be tested, so intricate testing will happen in your examination, very rare. So what you have to remember is this 10%, 10% on sum assured. So up to 10% it is allowed. That is for financial at 12-13. If it is from 1st April 2013, then you are splitting into 2 segments. One, you understand whether the policy is covered under 80U or 80DDB. Both are about people who are differently abled people. Okay. Both are for people who are differently abled. So basically 80U is differently able. 80DDB is specified disease. Okay. We'll call it a specified disease. So 80U or 80DDB. 80U is called differently able. 80DDB is you have some specified disease. So if you are covered under this, if the person is covered under this section, then you get an additional premium of 15%. Otherwise, it is 10%. So for most of the policies that will be tested in your examination will be this category. That is from 1st April 2013. In case if it is old, please remember it is very old. Very old is 20%. Just 1 year, that is 12-13 alone, financial at 12-13 alone. For that 1 year alone, it is 10%. For that 1 year alone, it is up to 10%. After that, from financial year 13-14, it is 2 rates. If you are covered, if you are either disabled or you are having any specified diseases, then it is 15%. Otherwise, it is 10%. So this is the premium level. Up to this is covered under 80C. Above this is not covered under 80C. So that is what you are discussing here. So any sum received on death of a person shall be exempt under section 1010D, irrespective of the premium limit. Why did we link it to section 1010D? 1010D says if the policy has a premium less than 10%, premium less than 15%, then that policy amount, when you are withdrawing the policy amount, it is exempt. So if you have taken a policy where the premium is less than 10%, which means the premium is eligible under section 80C, When I'm receiving the money from LIC, that is also exempt under section 10, clause 10D. But the condition is the premium amount should be within the prescribed limit. If it crosses that limit, I am not eligible for exemption. Similarly, in ATC, your deduction is eligible up to that premium limit specified. Above that, you cannot claim ATC. And we already discussed about what is capital sum assured and minimum sum assured. And the following shall not be exempt under section 1010D. Amount received under section 80DD by an individual, it is not. So 80DD is basically differently abled. So 80U is also differently abled. 80DD is also differently abled. So when any policy is received by a person who is covered under 80DD, that is not exempt. And any sum received under Keyman insurance policy by the partner or the person, then also that is also not exempt. So if that policy for which you are claiming ATC is a Keyman insurance policy, that receipt is not covered under 10D. And in case if you are not being premium paid for 2 years in case of other tenure, with single premium 2 years. So before you are not even paid premium for 2 years, but you have discontinued the policy, then that policy, whatever was claimed as deduction, will be taxable. So what is the condition? 2 years. If it is single premium, within 2 years you are discontinuing. If it is multiple premium, that is monthly, quarterly, half yearly, or annual, before premium being paid for 2 years. So that's what this condition is. And these are all rarely tested. So what is generally you have to keep in mind is, the only thing that you have to keep in mind is the percentage. 20 for very old, 10 for 12-13 financial year, 15 and 10 for the next subsequent policy. So that's the only thing that you have to remember. So that is the very commonly tested ATC. Other than LIC, other ATC is contribution to PF, which is nothing but any contribution to statutory or recognized provident fund can be claimed as exempt. With respect to PPF, that is public provident fund, I can deposit up to 1,50,000. When I say PPF or any contribution, PPF, I can deposit in my name, spouse name, or children name. So it is allowed in any of my family members' name, self, spouse, child. So that is what it is allowed. Suganya Samriddhi savings scheme account. So that is specifically for girl children. So the parent can claim deduction if they are depositing money in the name of girl child in the account of Suganya Samriddhi account. Housing loan, any repayment of loan, that is principal. Any principal repayment, stamp duty or purchase expenses. In the capital gain, we understand that what is allowed in capital gain, selling expenses. What is allowed in capital gain is selling expenses. Purchase expenses are not covered when you are calculating capital gain. Purchase expenses are only allowed under ATC. And these deductions will be treated as deemed income if you are selling that property within 5 years. If you are selling that property within 5 years, it becomes automatically taxable. Any annuity plan, be it LIC or anything, whatever contribution is made, any premium paid to this annuity plan is basically exempt. Any contribution to unit-linked insurance policy, unit-linked insurance plan, so it could be in the name of individual, spouse, child, or any member of HUF. So it is automatically covered. Only thing is it must be locked for a period of 5 years. Locked for a period of 5 years. That's the only condition. Additional account under NPS. So NPS is called National Pension Scheme. National Pension Scheme has 2 types of category. National Pension Scheme is covered under 80CCD. So it's basically 2 types of National Pension Scheme is there. First tier pension is covered under 80CCD. The tier 2 is covered under ATC. So any contribution, the central government employee to additional account under National Pension Scheme as a fixed deposit more than 3 years is also claimed as deduction. So you're depositing into National Pension Scheme as a fixed deposit and lock-in period is 3 years. Lock-in period is 3 years. For here, we saw 5 years for this and this, that is your house property and ULIP, we saw 5 years. But in National Pension Scheme, the lock-in period is only 3 years. So if it's for a lock-in period of 3 years, whatever deposit you have put into this additional account, that is tier 2 account, you are eligible to claim deduction under section ATC. And other things, tuition fees, anything paid for tuition fees for maximum of 2 children. So this is something beyond your education allowance and hostel allowance. We said 100 and 300. This is beyond that. So it also includes any full-time education, within India, then automatically you are allowed for 2 children. Any other fees apart from tuition fees, for example, building fee, we see various association or various colleges or schools collect for everything else, building fund, swimming pool fund, they name whatever they want and they collect extra money. You need not teach there are various organizations where you need not teach them on how to collect money from students. So basically what is allowed as ATC deduction is only the tuition fees alone, nothing else is allowed. And NABARD, notified bond by NABARD, that is National Agriculture Bank of Agriculture and National Bank of Agriculture and Rural Development. So if you are subscribing to the notified bonds of NABARD, it is exempt, whatever you are contributing. Any post office deposit, which has a lock-in period of 5 years, is also allowed. Senior deposit period, again 5-year lock period. I think income tax likes this number 5. So most of them you're seeing this lock-in period of 5 years. So it's very easy to remember. House property, 5-year. Then we saw this, these accounts like 5-year post office, 5-year term deposit, everything is 5 years. So everything what we have been talking about is about 5 years only, including ULIP and other thing also, it is 5 years. So all these are only covered as 5 years, and senior citizen deposit are in 5 years. So senior citizen deposit is a separate deposit scheme in various banks. If you're depositing money into that, there also the lock-in period is 5 years. And 5-year term deposits, selected fixed deposits with selected banks where a period of more than 5 years, so not less than 5 years. So if you are creating a deposit for more than 5 years, it is allowed. Maximum limit is 1.5 lakhs. National Savings Certificate. So there is some series called 7th series NSE. So this, whatever contribution you are making to the subscription is also allowed. Contribution to superannuation fund, this is also covered under ATC. So these are all the commonly tested ATC. Apart from this, there are few others also. I have just not considered certain things, considering the importance of the examination and the shortage of time that we have. So now that is all about ATC. So contributions made. Now there is certain deviations from ATC. That is, this is also contribution only, but there is a deviation. What it is? So we're going to discuss about ATCCC. It is ATCCC and ATCCD. ATCCC and ATCCD is specifically about pension funds. We'll first discuss about ATCC. So any person who's paid for annuity of LIC or any other insurance is basically covered under this. Interest or bonus accrued or not contribution. So when you say contribution, it is only real contribution. I am paying 50,000. So that is only contribution. Maximum deduction is 1.5 lakhs. So in ATC also, we saw several things add 1.5 lakh maximum contribution, such as PPF and other things, savings deposits and other things. Here also the maximum deduction is 1.5 lakhs. In case there is a surrender of annuity and pension is received from the annuity, whatever you are receiving, that is whatever balance it is. It could be bonus, it could be the contribution, it could be the interest. Whatever you receive becomes taxable. You could either surrender it fully or partly. The entire amount that you're receiving will become your deemed income. Whatever is the credit balance will be a deemed income. So the contribution is exempt, but when you're finally receiving it after surrendering it, it is taxable. You are not claiming it on maturity, you are claiming it on surrendering. So this is taxable. ATCCD is an upgraded pension fund, which is formed specifically by the central government. So it is called Atal Pension Yojana. So basically a central government employee will contribute 10% of the salary. Central government will also contribute 10%. So it's like PF only. Employer will also contribute, employee will also contribute, but not just central government employee, even other employees and self-employed, basically can deposit into this pension scheme. What is the deduction? If an employee is depositing maximum of 10% of salary. So employer is also 10%. Central government employee contributing is 10%. Employee contributing is also 10%. So we said, if employee is contributing 10%, that 10% is exempt. If any other person, that is who is not employed, if you are not an employee, you are self-employed. For example, I am a partner in a firm, I am not an employee. So if I am contributing, I can claim deduction of 20% on gross total income. 20% on gross total income. So if you're an employee, it is 10% of salary. If you are any other person that is other than employees, you are eligible for 20% of gross total income, 20% of gross total income. And apart from this deduction one, if there is any shortage, you can additionally claim under clause 1B of extra 50,000. So you are generally allowed as 10% and 20%. In case if there is a shortfall, you can claim extra 50,000 from this section 1B, clause 1B. And what about the employer contribution? So 2 talks about employer contribution. With respect to employer contribution for both central government and state government employee. Please remember, state government is an amendment. State government is an amendment, so it is important. So any employee, there is both central government and state government employee, the employer can contribute up to 14%. The employee can contribute 10%. Employer can contribute 14%. For every other case, maximum contribution is, that is every other employee. For every other employee, employer can contribute 10% of salary. When will this be called a deemed income? When you are closing or opting out, then such receipt, whatever receipt, 60% is exempt. So when you're closing that ATCCD pension fund and taking out the money, 60% is exempt, 40% is taxable. However, if this is happening on death, it is of course not taxable. You also have to remember the exemption on partial withdrawal is less than or equal to 25% of contribution. If I'm withdrawing only up to 25%, not more than 25%, and I'm not fully withdrawing, I'm only partially withdrawing. So on partial withdrawal, up to 25% is perfectly allowed. So that is the ADCCD. So now we saw 3 sections, right? We saw ATC. So we saw ATC, we saw ATCCC, and we saw ATCCD. So we saw both. So now whatever we have discussed. So whatever we have discussed is these 3 things, that is ATC, ATCC, CCC, and ATD, right? Just a second. So 3 things, that is ATC, ATCCC, and ATCCD. These 3 things is basically allowed, is what we discussed now. So independently, each ATC has a limit of 1.5 lakhs, ATCCC has a 1.5 lakhs, ATCCD has a limit of 10% of salary in case of employee, 20% of gross total income for any other person. So this is the limit specified under ATCCD. All these three put together as only a limit of 1.5 lakhs. So the maximum limit under ATCC, I usually tell idhukku paruthi mutta go down la irundirukalaangra mari. So basically your ATC savings limit is also 1.5. This is also 1.5. All put together is again 1.5. Then why unnecessarily give a limit here? At the end of the day, ATCC, all these 3 sections put together, it is 1.5 lakh. Irrespective of whether one section, one class, forget it. Totally, it is eligible only up to 1.5 lakhs. So what about ATCCD? National pension scheme is eligible up to 10% of salary if you're an employee. For everyone else is 20%. So all these 3 put together should be 1.5 lakhs. Now, for this section alone, you can claim additional deduction of 50,000. So if you are not able to give here, so if this is short, then the balance, this is short, the balance can be claimed under 1B. The employee can claim any left out deduction which cannot be claimed in ATCCE, can be claimed under ATCCD, clause 1B, extra 50,000. And we saw one more, right? ATCCD2, which is specifically for employer. So for this, there is no limit. What is the limit here? The limit is 14% of salary for government employee, 10% for other employees. And what exactly is salary? Basic plus DA forming part of retirement. That is our DAFE. So dearness allowance forming part of entitlement benefit. So only these three only is, this is what is about ATCCE. So basically there is an overall limit of ATC plus ATCCC plus ATCCD put together 1.5 lakhs. Independently also ATC as 1.5, ATCCC as 1.5, CCD with respect to employee contribution 10% of salary or 20% of gross total income. Then if there's any shortfall here, you can claim extra 50,000 under 1B. If employer is contributing, there is no such restriction. The restriction only 14% of salary in case of A government employee, 10% of salary in case of every other employees. What is salary? Basic plus dearness allowance forming part of entitlement benefit. So that is all about 80C. We'll move on to next section, 80D. 80D, remember D as disease. So 80D, 80D is D is for disease. I think it's not visible. So it is D disease, okay? 80D. I told you my handwriting is very poor. So 80D, D stands for disease. So it is 80D. What is the situation? Medical insurance or any health scheme can be taken for family. What is family? Self, spouse, dependent children, dependent children. So it is self, spouse, dependent children, self, spouse, dependent children. Maximum is 25,000. In case if any of them is a senior citizen, either the self or a spouse is a senior citizen, then it increases to 50,000. For parents also same, 25,000. If senior citizen, it is 50,000. If HUF, for HUF it is 25,000. If any member is a senior citizen, then it is 50,000. So technically, if you actually see, you are eligible for up to 1 lakh, 50,000 plus 50,000. If you are also senior citizen, your parent is also senior citizen, you are eligible up to 1 lakh. Sorry. In case, apart from paying for medical insurance premium, you can also pay for checkup. But maximum allowed is only 5,000. But whatever you pay, it is within the limit of this 25,000, 50,000 only. So this 5,000 is within this limit only. Within this limit of 25,000 and 50,000, it's not a separate limit. It's not plus 5,000. It is within this 25 and 50,000 only. If you are a senior citizen, and you do not have an insurance, if you do not have an insurance, you can claim medical expenditure. You can claim medical expenditure up to 50,000. So that is exclusively for senior citizen who are not having insurance. So if your question says medical expenditure so much, if that person is a senior citizen, even though there is no insurance, you have to add it in 80D. Your question might say that in your P&L or wherever, it say medical expense. Medical expense is 60K, okay? And let's say that person is a senior citizen. While computing, you have to include 50K in 80D automatically. You need not wait for anything because it is implied. It is implied. So if there is no insurance for a senior citizen, they are eligible for medical expenditure. Instead of insurance premium, they're eligible for medical expenditure up to 50,000. What is the payment mode? If you are doing health checkup, this is any mode. So it could be cash, whatever mode. But here, this no cash. So the only condition is no cash. And sometimes what happens is the premium will be lump sum. You will pay one premium altogether. Like this year itself, I'll pay 2 lakhs of premium. But this premium is valid for, let's say, 5 years. Automatically, I have to divide it. I have paid 2 lakhs divided by 5. So yearly 40,000. So I'll claim yearly 40,000. So if I'm a senior citizen, I can claim the whole 40,000. If I'm not a senior citizen, I can claim only 25,000. So that is what is about. So 1 divided by relevant previous year. 1 divided by relevant previous year is what I need to consider. And the next is 80DD. 80DD. DD stands for dependent who is disabled. Okay. So 80DD stands for dependent who is disabled. So the eligible assessee should be an individual or HUF, and the person must be resident, and the dependent should be a disabled. So the person dependent on them should be disabled. And who can be a dependent? Spouse, children, parents, brother, sister, wholly or mainly dependent. So that is what we are calling it as dependent children. So for spouse and children, dependency is not required. Parents, brother, sister, dependency is important. So wholly or mainly. If HUF, any member of HUF. What is the eligible expenditure? It could be treatment, training, or rehabilitation. For example, I am a differently able person. I'm not able to walk properly. I can take training. I can take a physio training to walk properly. So that expenditure is also covered. Paid under a scheme framed by insurer, Unit Trust of India, or any specified company, that is also covered. So the diseases not on the disability does not only include the physical thing, it also includes things like autism, cerebral palsy, and multiple disabilities. So all this is also covered. All this is also covered in your eligible expenses. And what is the condition? Payment of annuity of lump sum on individual's death or becoming senior citizen. So this is an amendment in Finance Act 2022. So basically the condition is the annuity plan for which I am paying premium, that let's say I am the taxpayer, I am paying premium, I am paying premium. Now, whatever premium I am paying, is basically, if subsequently that annuity is giving me the money, either on, there is no harm in telling this, either on my death or I am becoming a senior citizen. Because I took myself an example. So I will have to state this. So either on my death or me becoming a senior citizen, automatically whatever I receive is basically not taxable. That's what they're saying. So it's dependent on or nominee or trust. So in that case, it automatically goes, the money goes to the dependent or to the trust, which is actually, I have taken the policy, since I am no more, it will be given, or I have become senior citizen. This amount, whatever I'm receiving, could either be given to me if I'm a senior citizen, or it could also be given to my dependent, nominee or trust. So that's what it's saying. Certificate should be issued by the medical authority. Now, what is the deduction? Disability over 80%, it is 1,25,000. In any other case, it is 75,000. And receipt is taxable if such disabled person predecessors. So I am actually putting money for a person who's dependent on me, who's disabled. If that person passes away first, then that money becomes taxable. However, that person who's passing away, the differently disabled person, has passed away after I have attained 60. Then it is not taxable. So that is also an amendment. So what is the amendment in Finance Act 22? Two things. Your annuity receipt on becoming senior citizen, your insurance receipt on becoming senior citizen is not taxable. Next, the dependent for whom you have taken an insurance passes away, dies before you, and you have become a senior citizen. In that case also, it is not taxable. These two are the amendment. Earlier, it spoke about individual's death and person predecessors. Now they have added a concept called senior citizen. So please remember, it is a thing. 80U is a similar, exactly same. Whatever we have discussed here is applicable in 80U. Only thing is, 80U is for self. 80U is self. It is not for dependent. So it is 80DD is for dependent people. 80U is self-disabled. Self-disabled is 80U. Otherwise, same 1,25,000, 75,000. Such things are all remain same. So that is 80U. So 80U probably will not discuss it separately. It is self. If I am differently abled person, I can claim 1,25,000 if it is more than 80%. Otherwise, I can claim 75,000. Please remember, it's a flat deduction. It's not maximum of 1,25,000. It's not like that. It is a flat deduction of 1,25,000 and 75,000. And next is 80DDB. Generally, I come out with a stupid explanation for this. I'll call it as disease that is big. Okay. So it's a disease that is big. So 80DDB. So what do you mean by this? It's a disease which is very, very unique or very rare or very huge or something. So it is eligible for resident individuals in HUF. Specified medical expenditure, same as DD. That is, it is applicable for spouse, children, parent, brother, sister. Parent, brother, sister should be wholly or partially dependent on the taxpayer. So that is the eligible thing. What is the quantum? Actually paid or 40,000. If you are a normal person, if you are a senior citizen, actually paid or 1 lakh, whichever is less will be allowed. And if you have received anything from insurance or reimbursed by employer, automatically this will be covered here. Reduced amount received from insurer or reimbursed of employer. So this is basically the quantum. Of deduction. So, and then you have medical expenditure. So what type of medical expenditure is covered? Basically, you have to get a prescription and claim it. And what type of disease? Neurological disease, malignant cancers, AIDS, chronic renal failure, hematological disorder. All this will be covered. With respect to your diseases. So these things are called as neurological disease, malignant cancer, AIDS, chronic renal failure, and hematological disorder. These are actually called as diseases covered under 80DDB. So these diseases, if it's for, it could be for self or dependent. maximum is 40,000. If you're a senior citizen, the maximum is 1 lakh maximum. So there's expenditure or maximum, whichever is there. Next series, we'll be talking about E series. Okay. So far, we saw D series, that is disease. D was medical insurance. DD was dependent disabled. DDB was specified diseases. So these are the three things that we saw in 80D. Now we are going to move on to E series. E series is all about loans. So when you have taken loans, the interest payment on this loan is basically can be claimed as deduction. That is discussed under 80E. Okay, that is 80E series. So eligible assessee is an individual. So what is the condition? Loan is pursued for higher education, and it could be from a financial institution or approved charitable institution. The purposes could be for self or relative. When you say relative, it is spouse or children. And in case of any other student, you must be a legal guardian. Course after senior secondary, course after senior, that is after 12th, any course after 12th, that is your undergraduation, post-graduation, or whatever it is, that is what it is about. Whatever loan you have taken, interest paid on that loan, interest paid on that education loan. So the first E is education. First E is education. After this, I will not have any explanation. 80E is for education. Interest, entire E series is only on interest. Interest on loan paid, it is eligible for first year plus 7 succeeding years. So if you have got a loan year, it is eligible for, if you have gotten financial at 22-23, it is eligible in 22-23 plus 7 years, So that's what it is about. Next, we'll see about 80E. 80E, that is for house property. So 80E is house property, where an eligible assessee is an individual. He has got a loan to buy a residential house. On that date, when he is buying this loan, he doesn't have any other house. So that is his first house. First house, and the value of house does not exceed 50 lakhs. Loan does not exceed 35 lakhs. And the loan is sanctioned in 16-17. So it is only for 1 year. The loan sanctioned in 1 year. It is available for your entire loan period. So entire period of loan, but the loan should have been approved. Sanctioned. Loan should have been sanctioned in financial year 2016-17. So that's the major criteria that we are talking about. And it should be over and above section 24. So what does section 24 says? You're eligible up to 2 lakhs. You're eligible up to 2 lakhs or 30,000. So this, whatever is this, that is this 50,000 is excess, is above this section 24. So 2 lakhs there, 50,000 here, 30,000 there, 50,000 here. So it could be anything, but anyways, it's only for purchase of house. This 30,000 will not be available. So it is 2 lakh or 50,000. So it is above the 2 lakhs. 2 lakh in section 24, 50,000 you can claim in 80E for loan sanctioned in previous year 16-17. And subsequently, that loan was only for 1 year. 80E was only for 1 year. Then they brought out another section called 80EEA. So E is for house property. EEA is also for house property. So now what is that we are talking about? Basically, we are saying it is eligible assessee is an individual. Again, similar to what we saw in 80E. Loan must be borrowed from financial institution, and residential house must be purchased. Same condition, no other house. But what has changed? The value. There it was 50 lakhs. Here the stamp duty value should not be more than 45 lakhs. It's not about how much you bought. The stamp duty value should not be more than 45 lakhs. And the loan is sanctioned between 2019 and March 2022. So for your examination, that is previous year 22-23, this section will not be applicable if it is sanctioned in that year. Only if it is sanctioned in the previous period, it is available. And it is not eligible to the previous section. It should not be eligible under section 80E. So that is also a condition. How much is covered? 1,50,000. So 80E was only 50,000. Here it is 3 times 1,50,000 for the entire period of loan above section 24. So it is plus 2 lakhs. So apart from the 2 lakhs, you claim this 1,50,000. Apart from the 2 lakh, you can additionally claim 1,50,000 for these properties. What is the property? The stamp duty value is not more than 45 lakhs. There in 80EE, you had 2 situations. Property value is less than 50 lakhs, not more than 50 lakhs. Loan value is not more than 35 lakhs. Here, there is no restriction on loan value. The restriction is only on the stamp duty value. Next, we are going to see 80EB. Maybe you can remember it as electric bike. Okay, just remember it as electric bike. Of course, the first E will be for loan section. So 80E is loan series, 80EB is for electric bike. Wherever I'm able to tell you some stupid ideas, I'll give you. Otherwise, you yourself find a way to remember these section numbers, because remembering section numbers is important. Writing section numbers will give you more marks, but not writing will not make you lose marks. So don't write anything wrongly just for the sake of writing something. If you're very confident, very sure, write the section numbers. Otherwise, it's perfect. You can even skip at times. So the eligible assessee is individual. The loan must be borrowed from financial institution or from NBFC. Please understand where you can get the loan. 80EEB says you can also get it from NBFC. 80E says you can only get it from financial institution. But 80E says you can also get it from approved charitable institution. So these things you have to remember. And actually handle it accordingly. So these are the things that we are talking about. So what is the rule? The loan between 1st April 2019 and 2023. 1st April 19 and 31st March 2023. That's a loan period that you are talking about. This interest will not be allowed under other sections. Basically, this is the loan period that you're talking about between April 19 and March 2023. So the interest will not be allowed under any other section, which means if you're having a business, this interest, if claimed there, you cannot claim deduction. So you have to claim only one of them. Interest on loan paid is allowed up to 1.5 lakhs. It is eligible for the entire period of loan. When loan period is 5 years, I'm eligible for entire 5 years. So that's what it is about. So maximum is 5 lakhs. And in every these situation, there is 80E, 80EE, 80EA, EEB. In all these three sections, what matters is loan sanction. So the key word is sanction. Loan sanction is the key word. So only within this, the date sanctioned is relevant, not the date you have got the loan money. All that is not relevant. What is important is the loan sanction date. Next, we'll go to section 80G. G stands for gift. So gifting. So gifting is what? Donating. You're donating it. So 80G stands for gifting section. So that is 80G. An eligible assessee who pays donation to eligible funds or institution. This 80G is divided into 4 sections. Without qualifying limit, 150. With qualifying limit, 150. So these are the 4 branches of 80G. So what is qualifying limit? It is 10% of adjusted gross total income. So now you need to understand what is adjusted gross total income. So adjusted gross total income is gross total income minus chapter 6A deductions. So I claim chapter 6A deductions, less short-term capital gain under section 111A, less long-term capital gain, both under section 112 and 112A, and any exempt income or income in which there is tax is 0%. So there is no tax income. For which the entire profit is exempt or something, that amount also should not be included. So your gross total income minus these things is called adjusted gross total income. 10% of my adjusted gross total income is my qualifying limit. So I first identify what is my qualifying limit. I take 10% of gross total income. That is step 1. Okay, step 1. So this is only where with qualifying limit 150. It is not for anything else. And then you talk about donation, actual donation made in categories with qualifying limit. So in donation, whichever is less. So I take the actual donation. If I've donated 20,000, I take 20,000 and compare with qualifying limit. I compare the actual. I don't apply 100 or 50. I don't do that. I don't multiply 100% or 50% first. I take the total donation, qualifying limit or total donation, whichever is less. It is only where with qualifying limit. I take that, then I allow first 100%, then I allow 50%. So first I allow, if I've given 3 donations, all the 3 are with qualifying limit, 2 are 100%, third one is 50%. What I do is I calculate the qualifying limit. Let's say my qualifying limit, what is allowed is, let's say what is basically allowed is, let's say 20K. Now the 3 donations that I've made, it is 5K, this is 10K, this is also, let's say this is 6K. Now, What is maximum eligible? Only 20K. So first I have to allot 100%. So this 5, I will allot full 5. This 10, I will allot full 10. In this 6, how much is allowed? How much is allowed? How much is allowed is only 20 minus 15. 5 only is allowed. 5 into 50%. So 2.5 is allowed. So my total donation will be 15 plus 2.5, 17.5. 17.5 only will be allowed and not anything more or less. So this is how you calculate your ATG limit. So basically, the conditions are no deduction for any other portions. It cannot be in kind. Of course, it has to be money. And donation more than 2,000 must be made other than cash. Business connection is not required. Separate certificate will not be possible. For example, there is a Kerala flood fund, all these Chief Minister Kerala's Chief Minister Flood Relief Fund, Tamil Nadu Relief Fund. So these all are your employer will collect it from you and give it to the Chief Minister or Prime Minister or whomever it is. So these funds, that is Prime Minister National Relief, Chief Minister Relief Fund, and Lieutenant Colonel General Relief Fund. So these 3 type of funds, that is Prime Minister, Chief Minister, and Lieutenant General LG. So these 3 type of fund, you need not have a separate certificate. It is sufficient if you have a if your employer confirms that you have donated. So it need not have a separate certificate. And what are those with qualifying limit? So there are 50 and 100%. 50 is these 5 things. That is, first is eligible for charitable purposes. So that is basically charitable purposes. And then established by government. The government or any local authority is also for charitable purposes other than promoting family planning. Other than promoting family planning. So that is also not allowed. That is also another plan. An authority constituted in India, by any other law enacted in there. So this is for what purpose? Planning development of village or both cities, towns. So it is for regional development, also for housing accommodation. And then any corporation or established by state government for promoting interest of minority community. So that is also covered. And finally, religious purposes. So these 5 are called 50%. Charitable purposes are 2 types. Charitable purposes that are other than promoting family planning. So these 2 are charitable purposes. And then promoting infrastructure, housing accommodation, village, cities, etc. That is infra. So this is charitable. This is charity. This is infra. The third one is infra. This is minority community. This is minority. And this is religious. So charity, infra, minority, religious. So these 4 things are covered as with qualifying limit 50%. Without qualifying limit is family planning and sports association. That is Olympic association. Family planning and Olympics. Recently, these 2, family planning and Olympic association, are called as 100% with qualifying limit. So with qualifying limit is 50% and 100%. Without qualifying limit, there are so many. So I'm not going to go through everyone. Rather, what I will do is I will tell you a shortcut. Every without qualifying limit, everything in without qualifying limit will be something for national purposes or state purposes. It's not something like a purpose that is charity, sports, family planning. It will not be like that. It will be generally called as national or something like defense, army. So it will be something like on a broader perspective. It will not be very specific. So all this is what you're calling it as a 100%. There is also another way. I will tell you how to remember the without qualifying limit 50%. Without qualifying limit 50%. We all know Gandhi family, right? Initially it was Jawaharlal Nehru, and then you have Indira Gandhi, and then Indira Gandhi's son Rajiv Gandhi. These three name and these 3 people are basically called as without qualifying limit. Apart from that, Prime Minister Drought Relief Fund. Only this is also covered. So these 4 alone are called without qualifying limit. Anything else for general purposes will be covered under without qualifying limit 100%. So that is 80G. So 80GG is basically for rent paid where HRA is not there. Wherever HRA is not there, you may claim 80GG. Of course, it is for your own resident. That is, you are renting a place for your own resident, and the spouse, children, or should not own any accommodation, which means I am renting a place that in the same city, if my spouse or children or myself have another property on my own, It is not there. Whether you will be tested in exam, no, you will not be tested. If assessee owns at any property, should not be self-occupied. So which means I should not have another house which is not a self-occupied or deemed to be let out. So I am rented a place. I should not own any other place. Own any other place or in that location. In that location, I should not be owning. What is the proportion? We'll remember ALP as we saw in salary. A is your actual rent. Sorry, this is L. This is L. This is P. So A is actual rent paid minus. Sorry for the confusion. So instead of actual, here you have 5,000 per month. Instead of actuals, in HRA, we said actual HRA. Actual HRA, here actual is 5,000 per month. In HRA, we said the limit is 40 or 50% of salary. We said 40 or 50% of salary. Here it is 25% of such total income. And there we said rent minus 10% of salary, rent minus 10% of salary. Here the limit is 10% of total income. It is exactly like your HRA. So just compare HRA and this. HRA, you said actual HRA, here it is 5,000 per month. And then there the limit was 40% or 50% of the salary, depending upon the city. Here it is 25% on total income. And there it was rent paid, actual rent paid minus 10% of salary. Here it is actual rent paid minus 10% of total income. Exactly same. The least of the following will be deductible. So that is 80 GG. So moving on, we'll go to next section, which is 80 GGB and GGC. So 80 GGB and GGC. So basically any contribution to political parties, GGC is for individuals. GGC is for individuals. Any contributions to the political party is allowed. In section 37, we saw advertisements in souvenirs to political party. To political party is not allowed under section 37. Same thing can be claimed as deduction under section 80 GGC. So if your P&L in your question tells you that there's an advertisement souvenir in the nature of souvenir to political party, that must be disallowed in PGBP, can be claimed as deduction, under 80 GGC. So that is for individuals. GGB is for companies. So whatever contribution you are making can be claimed. And the next section of series that we'll be seeing is 80 JJAA. So what is 80 JJAA? We'll first understand that it is applicable as 30% of additional employee cost. Income tax, the government promotes you to have new employment to expand your business by having more people. So when you're having new employees, 30% of additional employee cost, can be claimed for 3 assessment year 1, year 2, year 3, 30%. So in total, you will be claiming extra 90%. No deduction shall be allowed if it is formed by reconstruction of existing business, or it is acquired by way of transfer as a business reorganization, or there is a form that is being filed. So that is what you call it. So we need to understand what exactly is additional employee cost. To know that, first we need to understand who is an additional employee, what exactly is the cost that we are talking about. So additional employee is the one who is employed during the previous year. And does not include whose salary is more than 25,000. So if the salary is more than 25,000, they are not counted. If the employee's pension is fully contributed by government, that person is also not covered. If employee is employed for less than 240 days, that is like 8 months. So if the employee is employed for less than 8 months in a year, it is not covered. But the number is not 240, it is 150 in the case of apparel, footwear, leather business. So these 3 business, apparel, footwear, and leather business, these are all seasonal business. So in these seasonal businesses, basically what happens is the number of days is not 240, it becomes 150. It's not 240, it's 150. So instead of 8 months, it becomes 5 months. For these 3 businesses alone. Now, in that particular year, I employed someone in December 2022, which means they have worked only in December, January, February, March, only 4 months. Now they have not worked 240 days. But why? Why have they not worked 240 days? Because they have recruited on 1st December only. How can they work for 240 days? So for new joinees, the 240 days will include current year and next year. Together, if you're being employed for more than 240 days, you are covered. So from December, January, February, March, April, May, June, July. So if you're working till July, you're automatically considered as an eligible employee. So if you're during the year, if you have recruited for less than 240 days, you can also check the next year for thing. And employees participating, not participating in recognized provident fund will also not be contributed. So such employees are called additional employee, and anything paid to them as salary is covered, and it should not include any lump sum payment or any contribution to PF pension. So when you say payment, whatever is paid to them alone is considered. And so additional employee, emoluments paid to emoluments, additional employee. So such thing is called additional employee cost. But only condition is if there is no increase in number of employees. For example, in this year, in previous year 20 to 23, I have recruited 20 people. It's like I'm having additional employee, 20 additional employee. But 20 people have quit my organization, which means there is no growth. New join is 20, quit people 20. So which means the net impact is nil. So if the net impact is nil or negative, this provision is not applicable. So not just new recruitment, your new recruitment should result in increase of employee strength. So that is the condition here. And of course, it should be paid only through account pay check. The salary that we are talking about, emoluments that we are talking about should only be paid through banking mode. So 30% is allowed for 3 years. So I calculate eligible employees. I identify the emolument. I calculate the employee cost. I multiply into 30%, claim it same amount. I'll claim it in year 1, year 2, year 3. So that is what is about 80 JJAA. The last of the section that we are talking about with respect to this other categories is royalty income. 2 things, that is 80 QQB and 80 RRB. QQB is for authors. RRB is for patents. So basically, the maximum deduction in both cases is up to 3 lakhs. The condition is, in both cases, the first condition is the person must be a resident. The second condition, in 80 QQB, the person must be an author. So who has written a book. 80 QQB, the person has written a book. Here, it's a first inventor. So the person who has invented, first inventor should be there, including co-owner. So co-inventor, not co-owner, co-inventor. So this inventor will be eligible to claim 3 lakhs. And whatever income they receive is eligible deduction of 3 lakhs. Here, whatever patent money I have received for the patent registered after 1st April 2003, I am eligible for up to 3 lakhs. So both are similar provisions. This is for author, this is for patent holders. And any lump sum consideration from book is covered. So not only regular income, also lump sum consideration is also covered. When you say books, it does not include textbooks. And even royalty, that is regular fees. This year I have sold 1 lakh books. I get royalty for that. That is also covered here. So the maximum deduction is 3 lakhs. Individual resident, author, I receive an income from that. So that is for QQB. What is RRB? Individual resident, first inventor, patent registered after 1st April 2003. Maximum deduction 3 lakhs. So royalty includes any transfer of right, providing information or use of patent. So anything related to royalty patent is basically covered under 80 RRB. So these are the 2 sections about this. And I have mentioned this wrongly. So other heads that we are talking about is interest income. So this is about specifically about interest income. So you have 80 TTA and 80 TTB. So 80 TTA is basically eligible assessee is an individual. The quantum maximum allowed is 10,000. It is allowed from savings bank. It is not from any type of interest. Only savings bank interest, maximum of 10,000. Whereas TTB is specifically for senior citizen. TTB is specifically for senior citizen. What exactly they're talking about? Eligible assessee an individual. Here it is. Why have I made so many mistakes here? I think I've just duplicated this. Okay, I'll write it and explain. It's 50,000. The maximum quantum is 50,000. This is not savings bank. It includes, we'll write it as any deposits, any time deposits also. Any deposits. So including time deposits, any deposits including time deposits. It's called senior citizen interest. So you have 80 TTA and 80 TTB. TTA, individual is eligible, savings bank interest alone up to 10,000. TTB, senior citizen who's having any type of deposits. It could be savings bank, it could be fixed deposits, it could be recurring deposits. So any type of deposits with the bank is eligible. Maximum of 50,000. Maximum of 50,000 is eligible for 80 TTB. So that is about your last section, deduction section under chapter 6A. So with that, we have covered all the deductions under chapter 6A. So next chapter that we'll move on is TDS and advance tax. So give me a couple of minutes. The next chapter that we'll be discussing is TDS and advance tax. The one thing that we need to remember in TDS and advance tax is this chapter as a whole is very much relevant, not individually. It should also be clubbed with your PGBP, because when you're solving a problem in profit and gains or business or profession, you need to understand whether tax has been deducted on a particular transaction or not. We were talking yesterday about net, dividend net, interest net. We were discussing about how to backward and reverse. Similarly, when transaction tells you that you have not deducted, not paid or something, you need to disallow. We saw section 40A. We saw section 40A. In that we saw 1 and 1A, right? We saw where we said TDS disallowances. We said TDSs will be disallowed. That is the expenditure. 30% of expenditure will be disallowed in 1A and 100% will be disallowed in 1. So it is important to understand what are these provisions as far as TDS is concerned. So, and we will start with each of the section. In all these sections, we'll understand in a typical format. So we'll first understand who is the payer, that is who's supposed to make the payment, that is the buyer of the service, buyer of the good or the service receiver. And second is who's going to receive the money, So it's basically the seller or the service provider. So that's what it's about. And third, we will understand what purpose of transaction we are talking about and when should TDS be deducted. That is time of deduction. Is it on credit basis or payment basis? And what rate is applicable? What rate is applicable is what we discussed. And then we will understand about are there any limits? Saying that are there any limits till which there is no tax deduction, any limit till there is no tax deduction. And then exclusion, it says that yes, this might be a similar transaction, but for this you need not deduct TDS. So specific exclusions is listed. If there is something else, we will understand this. So if we are going to understand the entire TDS with these 8 parameters, payer, payee, purpose, time, rate, limit, exclusion, and others. So we are going to understand the entire TDS provisions with these 8 parameters. So what are these first two things? I'm going to just simply explain and take it forward. First section is 192, which is salary. I'm not going to talk about these 8 parameters for salary. I'm only going to tell you that salary is taxable at average rate. So if you have an employee in your organization, his total salary during the year will be calculated. The income tax will be calculated for that whole year. And then it will be divided by 12 and you will start deducting month on month. So it's an average rate. So actual income divided, you apply the tax and calculate it. So that's what you're actually calling it as average rate. And 192A is for PF. So PF organization, that is your EPFO, that is the Employee Provident Fund organization. When after quitting, after resigning or something, or if you need some money, you can withdraw money from your PF account. So PF organization will give you money. When PF organization gives you money, they'll have to deduct at 10%. They'll have to deduct tax of 10% when they are actually making you the payment. So, but this is applicable only when the amount crosses 50,000. So the limit is 50,000. So when the income crosses, that is when the PF withdrawal crosses 50,000, 10% TDS is applicable. But one critical thing is, if PAN is not submitted, it is taxable at maximum marginal rate. What is maximum marginal rate? Highest tax rate of an individual is 30%. Highest surcharge is 37% plus education cess. So if you add these, you get a number that is your maximum marginal rate. And this TDS deduction will not be required if you are in a period of 5 years continuous service. 5 years continuous service. So if you are continuously working in an organization for 5 years and then withdrawing PF, it is not taxable. It is not taxable. And it is also not taxable when the resignation, when quitting that organization is not in your control, which means it could be because of health that you are not able to continue the work, or it is because of contraction. That is the employment, the company is shrinking, or shut down. The company is shut down. So because of these reasons, if you are quitting and withdrawing the PF, these are not in your control. Company shutting down or something. So in that cases, there is no TDS deduction. There is no TDS deduction. We already discussed this no control in the PF provisions when we discussed there. We discussed it. So this is the PF related deductions. So we'll move on to some regular sections. So we'll first start with section 193. Section 193, that will be called as interest on securities. Interest on securities. What is securities? Securities are like bonds, debenture. All these are called as securities. So payer, the person who pays can be any person. The person who's receiving, that is who's receiving the interest should be a resident. When should TDS be deducted? At the time of credit or payment, whichever is earlier. What do you mean by that? I'll only explain this once because this will be applicable in various other portions. Credit or payment, whichever is earlier. When you say credit, let's say I'm buying something. I will receive the bill. I will book it in my books of accounts. So the date I am crediting my vendor, I'm crediting my supplier, is called crediting. Or payment. In case if I'm making an advance payment, before buying itself, I'm paying an advance. Then payment is first. So what is first? Whether payment is first or crediting the books is first. So in that case, whichever is earlier, you have to deduct TDS. So the rate is 10%. So you have to deduct tax at 10%. There is no limit. So there is no separate limit, but there are some exclusions. Exclusions is national defense bond, national savings certificate, gold bond up to 10,000. For gold bond alone, it is up to 10,000. And debentures issued by specific institutions or public sector company or something, and specifically notified by central government, such as Power Finance Corporation and Indian Railway. These are mentioned in 54 EC. In 54 EC, there are 4 bonds. Out of that, Power Finance Corporation and Indian Railway Finance Corporation are notified by central government, which means interest given by them is not tax deductible. It is not tax deductible. So we are not talking about whether the income is taxable or not. We are only talking about whether the income is tax deductible or not. And debentures issued by company in which the public are substantially interested. In that case, up to 5,000, it is not followed. Up to 5,000, and it is paid by account payee check. So on these situations, it is not taxable. So next section we'll see is 194. So in this thing, I will suggest that key remembrance is 10%. So you have to remember 10%. If there is any limit, you have to remember that. But here, of course, there is no limit. So interest on securities is 10%. And dividend is also 10%. Dividend is also 10%. Who is the person paying? Domestic company. Domestic company is paying dividend. Recipient is a resident shareholder. So it is only applicable for resident shareholder. Dividend is distributed or paid. Dividend is distributed or paid before making any payment. Before making any payment, the dividend should be deducted. The tax must be deducted. So 10%. And it is not applicable when it is not crossing 5,000 and it is in the mode other than cash. So 2 conditions. The dividend amount should be not more than 5,000 and it should not be paid in cash. So these are the 2 situations. In that case, there is no TDS. Otherwise, you have to deduct 10%. So here also 10%. So both 193 and 194 as what percentage? 10%. Okay, moving on, 194A. 194A. So interest other than interest on securities. So 194A. So what is it talking about? Payer is basically any person. This also I will explain it one. From now onwards, from 194A onwards, there is a new payer. What type of payer? Any person other than individual or HUF whose turnover in the immediately preceding previous year, IP turnover immediately preceding previous year is more than 1 crore in business or 5 crore of profession. So any person including. So generally individuals in HUFs are not included, but individuals whose turnover is more than 1 crore, individuals whose turnover is more than 1 crore or profession receipt is more than 50 lakhs, they are also included. So any person including individual or HUF whose turnover is more than 1 crore or profession receipt is more than 50 lakhs, they are included. Otherwise, if a person is not, an individual is not running business, then this provision is not applicable. If an individual is a salaried employee, this provision is not applicable. If an individual is running a business, his turnover is only 50 lakhs, his turnover is 60 lakhs, is not applicable. An individual is running a profession, his total turnover is 30 lakhs, it's not applicable. So it is only applicable whose turnover is more than 1 crore in business or more than 50 lakhs in profession. The turnover we are referring to is the previous year. So if I'm working for financial year 22-23, I should check the turnover for financial year 21-22. And payee can be any resident. So this is common, any resident. What is the purpose? Interest income other than the interest on securities. That is like loan, fixed deposits, anything else can be covered here. Credit or payment, whichever is. What is the rate? This is also 10%. So this is going to add in line with 193 plus 194 plus 194A. Everything has only 10%. Now there is a limit specified. So it is 40,000 if it is paid by the banking company or post office or cooperative. In case of senior citizen, the aggregate is 50,000. But the aggregate for both this, for both 40 and 50,000, the aggregate is in the case of banks with core banking solution, which is interconnected banking. So which means each bank are interconnected and maintain a common database. Then this 40,000 and 50,000 is per bank. If there is no core banking solution, which means it's not integrated, each branch is independent, then the limit is per branch. So if it has core banking, yes, no, okay. If it has core banking, it is per bank, okay. Otherwise, it is per branch. So this is how you have to remember. So aggregate in case of core banking solution. If it is not a bank interest, then the limit is 5,000. However, it is not applicable when interest is paid. For example, I'm paying home loan, I'm paying term loan, I'm paying working capital loan. So these interest to a banking company, to a financial corporation, to LIC or insurance business. If I'm paying interest to any of these people, then there is no TDS deduction requirement. If I'm paying to any notified association, institution or association or body as may be notified, one of the notified is HUDCO, that is Housing Urban Development Corporation. Interest paid to a partner of a firm by firm, for that also TDS is not applicable. By an infrastructure company or a fund, infrastructure company or a fund or a PSU or a scheduled bank in relation to zero coupon bond issued on or after 1st day June 2005 by such company. So if any zero coupon bond is issued, for that also TDS is not allowed. Any interest paid by zero coupon bond is not allowed. So here and all it is to, here it is by. So paid by zero coupon bond, no interest needs to be deducted. So that is your provision of 194A. So 193, 194, 194A. So for all it is 10% only. Please remember. And next section is 194B and 194BB. So it is about winning from lottery, crossword or horse race. 194B says any person. 194BB says person involved in horse race. They are called as bookmaker. They are called as arranging or wagering or something. So anyone who's involved in horse racing, who's actually allowing you to bet or gamble. So that bookmaker or anyone who's allowed to do that is covered under 194BB. So that person is making payment to any person. For example, I go to a Big Boss reality show, I win. Vijay TV will pay me some money, right? So that money is covered under winning from lottery, crossword puzzle, etc. What is horse race? I go and participate in a horse race. I don't ride the horse. I bet saying that this horse will win. Now, if I win, the one who's going to give me the money need to deduct TDS. So any winnings from such people needs to deduct TDS. And what is the TDS rate? It is 30%, 30% credit or payment, whichever is earlier. So 30% for 115BB and under section 115BB. So 115BB is a section which tells you that these income will be taxable at 30%. We saw yesterday while studying income from other sources. Now this 30% is the rate of tax deduction. And what is the limit? It is 10,000. So up to 10,000, there is no thing. Please remember in all of these sections, the limit that I'm talking, that is the 10,000 or 5,000 or 40,000 or 50,000 I'm talking is, if your total interest or total income is less than that money, no TDS. If it crosses that limit, for example, if it is 13,000, TDS is applicable on 13,000, not on excess. So it's not like up to 10,000, no TDS. After 10,000, there is TDS. In all the sections that we are going to see, it is like a limit. If that limit crosses, it is for the entire amount. So once the limit crosses, it is for the entire amount. And one thing that we need to keep in mind is, sometimes when you're winning a lottery or something, for example, like Super Singer or something, you're given a house or a car or something. So what they say is, if it is given in kind, income tax wants to make sure that TDS is debited, TDS is accounted, TDS is credited, paid or accounted before issuing this house or car to you. So before even giving you this house or car, they have to make sure that TDS is deposited into the government account. So that's what they're actually calling for a requirement if it is in kind. And next to section 194C, it is one of the critical sections or commonly tested. So this is also any person. It basically includes every person, but it is not applicable for individuals in HUF. But it is applicable for individuals whose turnover is more than 1 crore in business, more than 50 lakh in this profession. So that is what it is about. And it is applicable for any payee, that is resident. And what is the purpose? For contract. For contract is what is applicable. Credit or payment, it's a common thing. This is most common. Credit or payment, whichever is lower. What is the TDS rate? 1% in case of individual HUF, 2% in case of every other person. So there are two rates, one for individual HUF, 2 for every other people. What is the limit? It's as a different type of limit. So per bill, if it is not crossing 30,000, there is no TDS. Per invoice, if it is not crossing 30,000, there is no TDS. Similarly, your total payment to that person, your total billing to that person in that year, if it is not crossing more than 1 lakh, then it is not applicable. So per bill crossing 30,000 or per year crossing 1 lakh, if either of this limit, or so per bill 30,000 or put together it is crossing 1 lakh, then automatically TDS is applicable. So this is the limit. It's not one limit. These are two types of limits: single limit, aggregate limit. And there are some specific exclusions. It is not applicable for personal purposes. So TDS is not applicable for personal purposes. And it is also not applicable for persons covered under 44AE. What is 44AE? We saw yesterday. Logistic business, number of vehicles up to 10 vehicles. You can file your return of income under presumptive taxation under section 44AE. If such person has furnished PAN, then I need not deduct TDS under section 194C for people covered under 44AE. And next is payment by broadcaster or television to production houses where only the telecasting right is acquired and content is already produced. We'll take Big Boss for example. Big Boss is telecast by in Tamil Vijay TV, I think in Kannada Colors TV or whatever channel we are talking about. Now, what is exactly happening? Vijay TV is Vijay TV has not produced this. The production is basically done by another producer called Andimal Production or something. So what happens is the production house is different, the telecasting right is different. So they say that If you have what you have obtained is only telecasting right, if what you have obtained is only telecasting right, then it is no TDS. There is no contract. If you are the producer, you are telecasting, then TDS is applicable. So there are two concepts, rights, that is telecast rights, and production. Production means content. Production content. If production content is there, telecasting right is all, then it is 194C. If production content is not there, only telecasting right is there, then it is not 194C. It is not 194C. So this is what you have to remember with respect to this. And moving on, payment made by customers to cooling charges. So what is cooling charges? Basically, it's a warehouse where you are allowed to maintain the products in a particular temperature, particular condition. This, as it was questioned whether it could be rental, because what I'm renting is the warehouse. But then it said that what you're renting is not only the warehouse, you're also renting the facilities, the temperature, what product at what temperature. So basically, it is not 194I, it is 194C. So amount of cooling charges is covered under 194C. And if it's any subcontract, if it is any subcontract, TDS is applicable only on the service, not on the material. So in case if they bill as separate amount of material, separate amount for work contract, then you deduct TDS only on the works contract. If it is combined, you have to do it on the whole invoice value, And what is work? It includes work. And we also said broadcasting or telecasting of such broadcasting rights, carriage of goods or passenger by any modes, catering is also covered, manufacturing or supplying of product. This is an important thing. Manufacturing or supplying product according to the requirement or specification of a customer by using material purchased from such customer or its related party. So now design and then material. Okay, there are two components. Okay, so design you equate it to content. Design is yours, material is also yours. So you give the design, you also give the material. This is 194C. This is 194C. But if design is yours, material is not yours, then it is not 194C. It is not 194C. So similarly, what did we discuss? Content, telecast. If content is yours, telecast is also yours, it is 194C. If content is not yours, only telecast is yours, it is not 194C. So this is the overall matrix which will help you understand this concept. And when I say this customer using material and design, what they are saying is either I can give material or my related party can give material. Both are covered. It is not restricted to me alone. Either me or my related party, if they give the material, it is covered. So design by one person, material either by that person or a related party of that person. So in both cases, this is covered here. So that is what they're covering under 194C. Hope it is clear. I've tried to keep it simple and make it little normal rather than making it a law or tax as such. I'm trying to keep it simple by giving some explanation. So hope it is useful and hope you are able to grasp it at a very short time. Next is insurance related. So it is 194D and 194DA. It is applicable for any person who is a resident. Commission for insurance business is for 194D. Credit or payment, whichever is earlier. TDS rate is 5%. And it is not applicable up to 15,000. If it crosses 15,000, it is applicable for the entire amount. 194DA, it is again for any person resident. It is for insurance payment. It is for insurance payments other than exempt. If it's an exempt policy under section 10 clause 10D, then you need not deduct anything. Otherwise, sum allocated plus bonus, other than exempt income will be covered. And what time of payment, I need to deduct 5%. Time of payment, I need to deduct 5%, and it is not applicable up to 1 lakh. It is not applicable up to 1 lakh. So that is about your 194 DA, right? So that is all about your section 194 D and 194 DA. So what are we talking about? Two sections on insurance premium. Moving on, we'll move on to understand about 194H. 194H, which says any person, including individual HUF, whose immediately preceding turnover exceeds 1 crore and 50 lakh. That is your regular person. Pay is any resident, that's also common. Any income by commission other than insurance commission. Why? It is covered under 194D. Or it could also be brokerage. Credit or payment, whichever earlier. This is also 5%. So 194D and 194H, both are 5%. For this also limit is 15,000. So for 194D also 15,000, 194H also it is 15,000. So we saw here 194D also 15,000, 5%. So here also it is 15,000, 5%. So try to link the provisions and understand so that it will be easy for you to grasp it better. And exclusions payable by BSNL or MTNL to PCO. PCO is your calling booth, STD booth or something. So if BSNL or MTNL, Maganagar Telecom or Bharat Sanchar Nigam Limited are paying to a public booth, TDS is not applicable as commission. And it is not applicable for professional services because it is covered under section 194J. And anything payment made by television channel for procuring or canvassing advertisements. So any payment by television channel, which is for canvassing advertisements, then automatically this is not applicable here. Canvassing for advertisements, it will not be applicable. So basically what happens is any amount that you're paying, for procuring or canvassing for advertisements, it will automatically not be covered under 194H. It's only for advertisement canvassing. If your work is something else other than advertisement, it is applicable. Advertisement canvassing, it is not applicable. Next section is 194I, that is rental. So payer is any person, again including individual or usual payer, usual payee. Purpose is rent, time is usual, credit or payment, whichever is later. Rate. For machinery, plant and machinery, it is 2%. For machinery, plant or equipment, it is 2%. For land, building, furniture and fitting, it is 10%. For land or building or furniture and fitting, it is 10%. So that is your rate. And your aggregate does not exceed 2.4 lakhs. Your aggregate does not exceed 2.4 lakhs is the basic limit. So maximum amount up to 2.5 lakhs, there is no TDS needs to be deducted. Above 2.4, it has to be deducted. And please remember the word is aggregate, which means it's machinery plus land and building. Both put together, you are checking for a limit of 2.4 lakhs. It is not machinery 2.4 lakhs, land and building 2.4 lakhs. Both put together, the limit is 2.4 lakhs. And if you are paying any lump sum payment as one-time upfront lease charges, which are not adjustable as rent. Not adjustable as rent, that is excluded. And any passenger service fee by airline to airport operator is also, these are all specific exclusions which are not covered. So payment of lump sum, if it is adjusted towards rental, it is TDS. If it is not adjusted towards rental, which means you'll get it back, or it is not adjusted towards rental, then it is TDS, and it is TDS, and it is not adjusted, it is not TDS under section 194I. And TDS is applicable whether or not asset is owned by payee, which means I am paying rent. I need not check whether that person is owner of the asset or not. So I can pay it to anyone. As long as I'm paying rental, I need to deduct TDS. So the ownership doesn't matter. And in case the bill does not split between how much is rental, how much is GST, I have to deduct it on the whole. Otherwise, I need not deduct TDS on the GST portion. I need not do that. Next section is 194IA, 194AA. So this is applicable for any person. It is about basically for certain transfer of thing other than agriculture land. So this is basically for compulsory acquisition, other than compulsory acquisition. So basically sale of any immovable property, other than agriculture land. The person could be, any person could be a buyer, seller could be a resident, and transfer of any immovable property other than rural agriculture land, credit or payment, whichever is earlier. Rate of tax is 1%, similar to 194C individuals, it is 1%. Up to 50 lakhs, it is not applicable. But if amount crosses 50 lakhs, you have to deduct it for the whole amount. Compulsory acquisition covered under section 194LA. So it is not applicable for compulsory acquisition. What is compulsory acquisition? We discussed yesterday itself in income from other sources. In Chennai Metro or Control, if they are taking over any land, if government is taking over any land, then automatically it is called as compulsory acquisition. So that is what it is covered here. and you need not have a TAN. What do you mean by TAN? It is called tax account number. It is something like PAN. So PAN is for filing income tax return, reporting your own transactions. TAN is for deducting TDS alone. Deducting and reporting TDS and TCS, you need to have a TAN. So all these sections which we saw, 194C, 194I, 194H, for all these sections, I will have a TAN. I will deduct TDS and report it under my TAN only. I will report it. But in this situation, if you actually look at it, I will be an ordinary buyer. So me applying a TAN and all is a very tedious process. So income tax says for this section, you need not have a TAN. It is based on PAN to PAN. And how do you determine this 50 lakhs? This consideration will include everything. So if you're buying a new property, these days the township has so many other costs: car parking, club membership, electricity, water facility fee, etc. All these costs which you are actually paying to the builder, will be applicable for calculation of 50 lakhs. So that's what it is applicable for this particular 194A. You should also consider stamp duty value of this. So if your stamp duty value is more than 50 lakhs, you still need to deduct TDS. So what you're paying is not only your consideration, you also have to check your stamp duty value. If your stamp duty value is more than 50 lakhs, it is automatically applicable. Okay, that is 194IA. Next section we'll see is 194IB. 194IB, which is basically for certain individuals in HUF. As I told you, this is applicable for individuals. It is only for individuals in HUF whose turnover is less than 1 crore, turnover is less than 50 lakhs in profession. So basically, persons who are not covered under 194I. 194I is your rental section. So if you are not covered under 194I, you will be covered under 194IB. So 194I is covered for any person, including individual HUF, whose business turnover is more than 1 crore or professional receipt is more than 50 lakhs. Now we are saying reverse. Any other persons who are not covered under 194I is covered here. So which means business turnover is less than 1 crore, professional receipt is less than 50 lakhs. Payee should be a resident. And what am I paying? I'm paying rental. We already saw a rental that was exclusively for those category of people. Now this rental is specifically for small individuals, salaried individuals, other people. And the rate is 5%. The rate is 5%, similar to 194D, 194H. So this is also 5%. So what is the rate covered here? 5%. And TDS is applicable when the rental payment is more than 50,000 per month. 50,000 per month. For this also, you need not have TAN. So what is it saying? What is the time? Last month of the previous year or tenancy, whichever is earlier. So basically what they're saying is, if I'm occupying the property from July 22 to March 23, I need to deduct TDS in March 23. If I'm occupying the property from July 22 to January 23, I need to deduct in January. So last month of tenancy or last month of the year, whichever is earlier, I need to do that. So that is what. So March 23 or that last month, whichever is earlier, I need to deduct 5% on any rental payment more than 50,000. Now, considering this, what is happening is, there are two sections, 206A, AB, where the TDS rate will be higher, typically somewhere around 20% or something. We'll come to that section later. Currently, you remember it as 20%. So for this, what they say is, they say that for this, the TDS in such cases covered under 206A, AB is 1 month rental. So it is not 20% here. Instead, it is last month rent. Why? For example, I'm occupying from April to March, 12 months. My monthly rental is 60,000. How much will I pay for 12 months? I'll pay 7,20,000. Now, in 7,20,000, usually my TDS is 5%, which will be how much? 36,000. So my TDS will be 36,000. So the last month rent, I will pay to the owner. I'll pay 60,000 minus 36,000. That's what I'll pay to the owner. I'll pay 36,000 as TDS to the government. 60,000 minus 36,000, I'll pay to the owner. So that is what I'll do. Now, assuming that person, the owner, does not have a PAN, I'm supposed to deduct 20%. Now, if you apply 20% on 7,20,000, it comes to 1,44,000. It comes to 1,44,000. Now, in this 1,44,000, which is more than 60,000, which means I need to call my owner and say, You give me 84,000, only then I can debit, I can account for. So will my owner give me that 60,000, or will I be ready to put extra 84,000 and pay that? So I will not be ready. So in that case, your TDS is only 60,000. It's not 1,44,000. So that is why this rule of this comes for these two sections alone, because my TDS amount is more than 1 month rental. So I am restricting into 1 month rental. That is 194 M. So next section we'll discuss is 194G. This is also an important section. So any person, including individual, same usual payee, usual payer, usual payee. There are 5 transactions. 5 transactions: professional services, technical services, sitting director fees, that is payment to any directors, royalty, non-compete fees, non-compete. So these 5 are covered under 194J. In this, what is professional services? Services that are listed under 44A, that is auditor, interior decorator, consultant, all these are covered under 44A. What is technical? Management, technical and consultant services. Technical services refers to managerial, technical and consultancy services. Payment to director could be remuneration, commission and fees. And then it could be royalty. Then you also have royalty, and then finally non-compete fees. So now what is the time, credit or payment, whichever is given. Rate, as far as rate is concerned, any rate that is for fees for technical services, that is this portion, B, that is this portion, A. So anything which is covered under fees for technical services, that is for A, it is 10%. For A, it is 10%, which is not professional services, that is fees for technical services, that is not professional services, it is 2%. For everything else, it is 10%. So typically, for A alone, it is 10%. For B to D, that is B, BA, C, and D, it is 2%. So technical services, payment to director, royalty, non-compete fees could be only 2%. Whatever is being paid to the professional services specified under 44A, accountant, architect, engineer, doctor, lawyer, paid to them will apply 10%. So real professionals 10%. Anything other than professionals, it will generally be 2%. So that's what it is about. And limit, it's a very different limit apart from all other sections. Limit is per category. Each category has a limit of 30,000. A has 30,000, B has 30,000, C has 30,000, D has 30,000. B alone, no limit. Which means even if you are paying 5,000, you need to deduct TDS. For everything else, the limit is 30,000. 30,000 per bill or aggregate. So total 30,000. So per person, per transaction, you are crossing 30,000. It is applicable. So separately applicable for each clause. 30,000 is separately applicable for each of the clauses specified here. That is in A to D, A, B, B, A, C, D. B, A has no limit. A, B, C, D independently has a limit of 30,000. So this is also something you have to keep in mind. What are the exclusions? If it is personal purpose, it is not covered. If it is for any software, we'll call it as ready-made software. I will not go through the conditions listed below. If it is for ready-made software, it is not available. But there is a specific inclusion called as third-party administrator. They are basically called as TPAs. So TPAs are mediator between the insurance agency and the hospitals. So any TPA, it is called as technical services. So any TPAs, services provided by TPA is covered as technical services. And anything others, that is professional services or services rendered by these people, that is covered under 44AA will be covered as professional services, which means for them it is 10%. For others, it will be 2%. So that's about 194J. And next section is 194M. 194M is basically for individual same payer. 194M is something like 194IB. 194IB, what did we say? 194IB, what did we say? Rental payment more than 50,000. It is specifically applicable for people who are not covered under 194IE. So 194IB is applicable for people who are not covered under 194IE. Similarly, 194M is applicable for people who are not covered under 194C, 194H, 194J. So it is specifically for small time individuals whose business turnover is less than 1 crore, or professional turnover receipt is less than 50 lakhs, or they are not into business at all. So it is for individuals who are not covered under 194C, 194H, and 194J. And anything payment to a resident is covered here. Credit or payment, whichever is earlier, is covered. Rate is 5%, similar to 194D, 194H, and 194IB. So all of this are covered under 5% category. So this is also 5%. And it is not applicable if it is not exceeding 50 lakhs. If it is not exceeding 50 lakhs. Where else you have seen this 50 lakhs? You saw it in 194 IA. That is when you are buying a property. When you are buying a property, TDS is applicable under section 194A, IA at 1% when your total consideration is more than 50 lakhs. So this 50 lakh we saw in 194A. I'm just giving you a hint to say that if you're linking and understanding, it is easy. When you talk one section, try to relate and see where else you have seen this number, where else you have seen this provision. So try to understand so that it easily remains in your memory. So does not exceed 50 lakhs. And exclusion, if TDS is applicable under these three sections, then this section does not come into picture. So this section comes into picture only when TDS is not applicable under 194C, 194H, and 194J. For this also, you need not have a TAN. So for what other sections you need not have a TAN? 194 IA, 194 IB, and now 194 M. For all these three sections, you need not have TAN. So this is also a common parameter that you can remember. So this is 194 M. It is only applicable for transactions that are not covered C, H, and J. What is the limit? 50 lakhs. So if your total payment crosses 50 lakhs, then TDS of 5% is applicable. So that is 194 M. 194 N is for cash withdrawal. 194 N is for cash withdrawal. So typically cash withdrawal is for banks, resident, cash withdrawal is for payment. So at the time of payment, TDS needs to be deducted. So when bank is giving money, I go to a bank and withdraw money, I need to see whether TDS is applicable or not. So if I have filed return for 3 years, TDS is applicable when I'm withdrawing more than 1 crore. If I have not filed my return for 3 years, first from 20 lakhs to 1 crore, it is 2%. For more than 1 crore, it is 5%. So if I'm regularly filing my returns, the TDS rate is lower. If I'm not filing my returns regularly, the limit is 20 lakhs. It starts with 2%. When it crosses 1 crore, it becomes 5%. So that's the limit. So limit is overlapped here. Exclusion, of course, any payment made by the government to banking company, white label ATM operator. So basically those who fill the ATM and other things, it is not applicable. Agriculture, market and other things, it is not applicable. $194O is e-commerce operator. We all know how Amazon operates, how Flipkart operates. They don't directly sell. They sell it through a, they only act as an operator. So they are a market aggregator. So they are called as e-commerce operator. So they are owning and operating a website, a digital or electronic platform, Ola, Uber, Airbnb, whatever sites. Today, these days, there are plenty of sites which acts as market aggregator. And the e-commerce participant is one who is actually the seller, the real seller. The seller. Now, this seller is selling goods or provisions through this e-platform, through Amazon or through platform. And credit or payment, whichever is earlier is applicable. 1% is the TDS rate on gross amount of such sale or service or both. So 1% on gross amount, and it is not applicable if the payment is up to 5 lakhs in a financial year. So if a payment is up to 5 lakhs and the seller has PAN or Aadhaar something, then it is not applicable. Exclusion, if TDS has been deducted under any other section, if TDS has already been deducted under 194C or something, then the section is not applicable. And sometimes we don't directly pay to the seller. We will pay to Amazon. Amazon will pay to seller. Sometimes we'll directly pay to the seller. So when you say this 5 lakhs, 5 lakhs should include direct payment also. Direct plus indirect, which means directly paid by the Amazon, indirectly paid by me directly to them. So that is what it is about. Now, if you go by Ola or Uber, you pay directly to the driver. Ola will not pay to them. So when calculating 5 lakhs, you have to calculate both the amounts, both what you are paying the seller directly, what has been received by the Amazon also. The total amount crossing 5 lakhs is only what is considered. And next, last section in TDS is 194P. Not last section, you have one more section, I believe. So 194P. So 194P is basically if you're a specified senior citizen. If you're a specified senior citizen, so specified senior citizen who's 75 years or more. So when a bank is paying, for us to the specified senior citizen, TDS rate will be like salary. Means I will calculate average rate. I will calculate my total income, calculate chapter 68 deductions, provide rebate, do everything. Whatever is the tax applicable, that person will be deducted. Why is the bank doing all this? Because this specified senior citizen need not file return. Need not file tax return because he has account only in one bank. That bank only pays him pension. That bank only pays him interest. So the pension income and interest is from the same bank, and he is 75 years more. So if these conditions are satisfied, bank will deduct actual tax. They will not deduct for interest. Interest we saw it is 10%. They will not deduct 10%. They'll deduct actual TDS, and the senior citizen, specified senior citizen, need not file return of income. And purchase of goods, it's effective from Finance Act 2021. Payer is a person whose turnover is more than 10 crore. Payer is a person whose turnover is more than 10 crore. Resident seller, if the seller is selling goods to this buyer, credit or payment is 0.1% on amount of above on if the limit crosses 50 lakhs, it is 0.1%. So if I'm selling for 60 lakhs, 60 lakhs into 0.1%. So it's for goods purchase. So more than 50 lakhs. Buyer's turnover is more than 10 crore. Buyer's turnover is more than 10 crore in the turnover in the EP. So for them, the TDS is 0.1%. Limit is 50 lakhs. So that's what it is amount. We'll skip this, the not much importance. And new section from 1st July 2022 is basically any person whose turnover crossing. So usual payer, pay is a resident. They are giving any benefit or perquisite. So within business, let's take medical business. Medical executives give lot of benefits to the doctors or someone. So basically, when benefit or perquisite is some additional benefits given to the dealer, distributor, agent, or whomever it is. So if something is given to that, 10% TDS must be deducted if the value crosses 20,000. If the value of perquisite is more than 20,000, then 10% must be deducted. And it is not applicable on sales discount, cash discount, and rebate. So this benefit or perquisite does not include sales discount, cash discount, and rebates. And it is also not applicable when it is provided to a government entity like government hospital who's not carrying on business or profession. It is provided to a government entity which is not into business or profession. It is not applicable. And for this, lower deduction under section 197 cannot be claimed. Lower deduction is something, let's say I am a chartered accountant, my tax TDS rate is 10%. So clients paying me will be deducting 10%. But if I'm proving to the income tax saying that my total tax at the end of the year will not be 10% and all, will be a very small amount only, I can apply to the income tax officer and say that my total tax will not be 10%. It will be very low. So, and I can get some lower number, let's say 1% or 0.5%, and give that to my client, saying that income tax has allowed me for a lower deduction. So that provision is not applicable for this section. It's not applicable for this section. And I'll ignore these. And it could be cash or in kind, similar to 194 B and BB. That is horse race crossword puzzle. The gift can be in cash or kind. It is applicable on both. So that's what is there. And next two sections, that is all about TDS sections. We'll understand about special rates in 206A and AB. 206A is rates prescribed in the Act, rates in force. We'll not discuss what is the difference between these two because it's a final topic. We'll just understand what is the rate as per TDS. So if it is 194C, it is 2%. If it is 194J, it is 2 or 10%. If it is 194I, that is also 2 or 10%. Now it says 20%. It says 20%. Only for these two situations, that is 194O and 194Q. That is 194Q is only 0.1%. So in 206A, it is 5%. So similarly for 194O also, it is e-commerce operator, it is 1%. For this also, it is For this also it is 5%. So for e-commerce operator and your goods purchase, this is 0.1, this is 1%. For these two alone, it is 5% and not 20%. So the highest rate will be deducted. What about 206AB? 206AB is for persons resident who has not filed returns for 2 assessment year immediately preceding the previous year. So last 2 years I have not filed my return, and my aggregate TDS is more than 50,000 in each of these 2 previous years. So for example, if you're talking about financial year 22-23, I need to see assessment year 22-23, assessment year 21-22. In these 2 years, I should have filed my return. If you have not filed my return, if it's not visible, I'll write here assessment year 21-22, assessment year 22-23. I must have filed my return in both these years. For financial year 22-23, I consider these 2 years. So in these 2 years, I should have filed my return. If I have not filed my return, in case if my aggregate TDS is more than 50,000, then more than 50,000, then twice or 5%. Applicable rate, for example, in 194C, it is 2%. So twice will be into 2 will be 4%. 4 or 5%, whichever is higher, so will be taken. So 5% will be taken. 194J, 10% into 2 will be 20%. So 20 or 5, whichever is higher. So I'll deduct it at 20%. So where both are applicable, 206A and AB both are applicable, I take higher of the 2 rates. And this is not applicable for these sections. 192, the salary, PF, the casual income, the horse race, buying property, paying rental, personal expenses, 194 CHI, 194N is cash withdrawal. So it is not applicable for these sections. If in detailed sessions, in detailed classes, I will probably explain why these sections it is not applicable. But here, considering the marathon session, we cannot do that. So you have to remember these sections and understand it is not applicable for these sections. Advanced taxes not applicable for senior citizen. For senior citizen who's not having PGBP. So senior citizen who does not have PGBP, there is no requirement of advanced tax. Otherwise, advanced tax is applicable if your final tax payable is more than 10,000. What is final tax payable? Tax minus TDS minus advanced tax paid. So net tax payable, if it is more, we'll also remove advanced tax. So tax minus TDS, if your net tax is more than 10,000, advanced tax is applicable to you. So you have to pay advanced tax in 4 installments. That is for every quarter ending 15th. June 15th, September 15th, December 15th, March 15th. What is the limit? I should pay 15%, 45%, 75%, and 100%. These are the limits I need to pay. If you are following presumptive taxation under section 44 AD and ADA, your advanced tax is applicable only once. So the entire advanced tax should be remitted by 15th of March. So it's not 4 quarters, it's only 1 quarter. So that is all about TDS and advanced tax. Now we'll enter into the 10th chapter, that is your return filing. So return filing is about regular return filing. So section 139 talks about return filing. 139.1 says that return filing is compulsory for companies and firms. For other persons, it is applicable if it is exceeding basic exemption limit. That is, if it is more than 2.5 or 3 or 5 lakhs, if your income, what income? Total income. When you say total income, it is before giving impact to exemption section or chapter 6A. Capital gain exemption, that is 54, 54B, 54EC. Before giving these, if your total income is more than 2.5 lakhs or 3 or 5, depending upon the type of person, then you need to file your return of income. And 3 is called loss return. Loss return is required because to carry forward a loss, it is mandated to file return on time. So in the current year, after set off, if you need to carry forward, you need to file the return on time. That is return on time specified under section 139.1. So other than house property loss and depreciation loss, other than these 2 losses, for every other loss to carry forward, you need to file it on time. And if you have not filed your time within the due date, you can still file belated return within 3 months. That is prior to the end of assessment year. So it is basically like 31st December. So my year end, assessment year end will be 31st March, 3 months before. So it will be 31st December. Revised return, in case if I have made a mistake or I have missed something, for this also the due date is 31st December. 31st December. When for classroom purposes, for marathon session purposes, we will not discuss this. So it's end of the assessment year or completion of assessment, whichever is earlier. Usually the due date will be 31st December. And we'll discuss 9 before going to 8A. 9 is called defective return. If you have filed the return under section 1 or 4 or 5, and income tax has identified some mistake, they'll intimate me the defect and they'll give me opportunity for 15 days. I'm supposed to rectify this. I'm supposed to rectify this within 15 days. That's what it's talking about. And what is 8A? It is called updated return. Updated return, if I could have furnished my return under 1, 4 or 5, I may file updated return. For what? I'm going to make any changes, but I have crossed the time limit. So 139.4 has crossed 139.5. That is, I've crossed 31st December. So for financial year 22-23, for financial year 22-23, the assessment year, financial year 22-23, the assessment year will be 23-24. So basically, I should have filed my return by before 31st December 23. I have to file my return before 31st December 2023. So for financial year 22-23, assessment year is 23-24. So the due date will be 31st December 23. So I should have filed my return before 31st December 23, either belated or whatever return. But if I have not filed, I can still file. If I'm filing it in the first year, I need to pay extra 25% tax. If I'm filing it in the second year, I need to pay extra 50% tax. So I can file up to 2 years from the end of my assessment year. So it is not applicable if I am booking a fresh loss, or I'm decreasing my tax liability, or I'm increasing my refund. So I'm creating a loss, I'm decreasing my tax liability or increasing my refund. I can't file my this updated return. And it is also not eligible for cases where raid is happening, search is happening, survey is happening. And once I have filed, I can't file it again. So I can't revise the updated return. So I can't revise an updated return. And then if an assessment is already completed, I can't revise. If you have issues, if you have problems in FEMA, that is Foreign Exchange Management Act, or Binami transaction, black money, DTA is international transaction. DTA is international transaction, offense prosecution. In that case also, I cannot file. So the maximum time is within 24 months from the end of relevant assessment year. Within that, I need to file my time. So this is about filing my return. But we said generally a return for individual is applicable only when they are crossing the basic exemption limit before giving capital gain exemption, chapter 6A deduction, or any section 10A, 10AB benefits. Now, apart from that, even though your basic exemption limit is less, even though you don't have an income, you still have to file your return of income when you have a current account and your deposit is more than 1 crore. When you have a current account and current account, your deposit is more than 1 crore. When you say more than 1 crore, it is aggregate. It is aggregate, which means if you have 5 accounts put together, it is more than 1 crore. Or if you have a foreign travel expenditure more than 2 lakhs for yourself or for anyone else, you have spent, you need not travel. If you have spent foreign travel expenditure more than 2 lakhs, it is applicable. Electricity consumption. So you are paying electricity for more than 1 lakh in 1 year. So this is also year. So 1 lakh was also year. This is also year, per year. So this is also year. So everything is per year. Or other conditions. Now, what are the other conditions? Other conditions is where my total sales or total turnover is more than 50 lakh, 60 lakh in business. My profession is more than 10 lakhs. My profession gross receipt is more than 10 lakhs. My TDS plus TCS is more than 25,000. If you are a senior citizen, it is more than 50,000. Savings bank account deposit more than 50 lakhs. Earlier we said current account more than 1 crore. Now we are saying savings account more than 50 lakhs. Earlier we only spoke about electricity and foreign travel expenditure. Now we are talking about turnover. Business turnover more than 60 lakhs. Profession turnover more than 10 lakhs. TDS, TCS is more than 25,000. This is a very recent amendment. So it is applicable from this year only, that is financial year 22-23 only. So basically what happens is your return needs to be filed. But within what time? Within what time? If you are a company or any person whom audit is mandatory, it is 31st October. It is 31st October. If you have transfer pricing provisions, what is transfer pricing provisions? For short, I will tell you international transaction with related party. So that is transfer pricing. So if you have international transactions with foreign related party, the due date is 30th November. For any other assessee, it will be 31st July. For any other assessee, it will be 31st July. So that is your due date, and we already saw this. What if you are not filing a return on time? If you are not filing a return on time, you have to pay simple interest of 1%. You have to pay simple interest of 1% for every month or part of the month. So basically, when you're filing a return, from the date of filing till the due date of furnishing return. So for example, my due date is 31st July, but I'm filing it on 30th November. I'm filing it on 30th November. Automatically, my due date will be covered from, that is 31st July, 31st October, I'm filing. My interest, 234A interest will be calculated till October, So I'll be paying from April to October. So 1% for every month or part of the month. And no interest shall be levied if the assessee has paid all the taxes. So if you have paid all my taxes, so there is no tax due, then no 234A. You also have 234B, 234C. 234C is for late payment of advance tax. 234B is for late payment of taxes. So 234B is also 1% for late payment of taxes. 234C is quarterly, that is 1% for every quarter. You will be calculating it. And apart from these interests, you also have 234F. If your income is up to 5 lakhs, you pay 1,000. If your income is more than 5 lakhs, you have to pay 5,000. So that is the limit. So for in other cases, if you have not filed it on due date, so when you're filing on 31st October, your due date is 31st July, you are filing it on 31st October, you have to pay 234A also, you have to pay 234F also. So 234A plus 234F will be applicable for you. And 234A will not be applicable when you have paid all your taxes. But 234AF is not bothered about your payment of taxes and all. So this is all about your return filing. So whatever we have covered here is what return filing is all about. So probably for the next half an hour or so, we'll be talking about the total income and tax payable, certain things that are critical for your examination alone. So we'll be discussing about that. Total income and tax payable. So in total income and tax payable, I would like to tell you about another tax mechanism, which is called as alternate minimum tax. Which is discussed in section 115JG. So alternate minimum tax. So what exactly is alternate minimum tax? Your Income Tax Act says you calculate tax as per regular mechanism. But I also want you to calculate tax for persons who have profit-linked and investment-linked deductions. So what is profit-linked and investment-linked deductions? Section 10AA is for SEZs. So SEZ is eligible for claiming exemption based on for 15 years. They can claim for 15 years. First 5 years, 100%. Next 5 years, 50%. Last 5 years, 50% or amount accounted into SEZ reserve account. SEZ development reserve account. So that or this, whichever is lower will be allowed as deduction. So that is section 10AA. So you're eligible for deduction for 15 years. Section 35AD, we already saw 100% of capital expenditure. Heading C, Chapter 6A. For intermediate, Heading C, Chapter 6A will have 80JJAA. What is this? Additional employee cost. What is additional employee cost? We said that if you have additional new employees in the year whose salary is less than 25,000, whose PF or other contributions is not contributed by government, and who has worked for more than 240 days in the particular year. It is 150 days in case of 3 business, apparel, leather, and footwear. Now, for these employees, whatever amount is being paid, you claim 30% deduction for 3 years. That is 80JJAA. Now, this 80JJAA is what you call Heading C. Heading C is basically profit-linked deductions. So your deduction is based on some business activity, some profits that you have defined from your business activity. Apart from this, any other income that has zero tax, which is part of your income, should also be considered. So these income is what you're calling it as profit linked and investment income. So basically, to have a regular tax flow, what government says is, for companies, they have something called MAT, minimum, that is minimum alternate tax. So this alternate minimum tax is for other than companies. That is discussed under chapter. That is just chapter 12BA is under Income Tax Act. And it is not applicable whose adjusted total income is less than or equal to 20 lakhs. So what is adjusted total income? Total income plus exemption given under section 10AA, deduction claimed under section 35AD, deduction claim under section 80 JJAA, 80 QQB, 80 RRB. So these three sections are called heading C deductions: 80 JJA, 80 QQB, and 80 RRB. So if you're adding all these incomes, you get adjusted total income. You apply 18.5% on adjusted total income. As an individual, you have slab rate, right? You have slab rate, but this alternate minimum tax calculates all these income and applies 18.5% directly. So this 18.5% is what you're actually calling it as your adjusted total income. Now, this tax, this 18.5% or your actual income tax, 18.5% or your actual income tax, whichever is higher. So I compare this 18.5% or slab rate, whichever is higher. So that will become my tax. So that is what 115JC says. But whatever excess paid, let's say this is 100, this is 80. So 100 minus 80 will be 20. This 20 will be taken as credit. That is AMT minus regular tax. And that can be carried forward up to 15 assessment years. Subsequently, in any year, when my slab rate is higher than this alternate minimum tax, I can use this credit of 20. But this AMT credit is allowable even in that year if your income is less than 20 lakhs. So AMT credit, utilizing the credit, you need not see this 20 lakhs. You need not see whether you have income here. So to utilizing the credit, you need not see any of this, but it is important to actually calculate every year and see whether it is applicable or not. So whatever is the credit can be adjusted, and every provision, that is advanced tax 234A, B, C, shall also apply to alternate minimum tax. So 234C will be applied on the alternate minimum tax. 234B will be applied on alternate minimum tax. 234A also will be applied on AMT. So it is applicable, but it will be applied on AMT. So that's what it is important to understand, whatever it is. Now, moving on, the next thing, that is your new regime. We were talking about this new regime under section 115 BAC. We said we'll discuss later on what is specifically not allowed. Now and then we also said certain things. So basically in salary, LTC and HRA is not allowed. Special allowance for office duties is not allowed. When you say special allowances, certain things are allowed. What are allowed? Your daily allowance is allowed. Your conveyance allowance for commuting between office activity. For office activity, if you're getting any conveyance, I took a Ola to go to client place, that conveyance is allowed. And any transport allowances for differently, that is 3,200 per month. These three allowances are alone allowed under special allowance in new regime. It is not allowed for everyone. Similarly, standard deduction under section 16 is not allowed. So these are all the elements that are not allowed in salary. What about house property? Interest on self-occupied property, that is up to 2 lakhs. Interest on self-occupied property cannot be claimed under new regime. Exempt income. There are certain things that are claimed as exempt income. For example, daily allowance to MPs and MLAs are not taxable. Exemption of minor children, that is 1,500 per year, per child per year. This is also not allowed. So these two things, in clubbing, we saw about exemption to minor children. This is also not allowed. So daily allowance to MPs and MLAs is not allowed. Exemption of minor children is also not allowed. So this is also not allowed. Coming to PGBP, depreciation is not allowed. What depreciation? Additional depreciation alone, what did we say? 20% for new plant and machinery. So that alone, that depreciation alone is not allowed. Regular depreciation is allowed. Additional depreciation is allowed, not allowed. Scientific research is not allowed. So section 35. Section 35 is not allowed. Investment linked specified business. 35 AD is not allowed. Expenditure on agriculture products. So that is also a series of 35. That is also not allowed. Expenditure on family pension. So this is also not allowed. So section 36 says any expenditure on family pension can be divided by 5 years, can be claimed over a period of 5 years. That is also not allowed. So all these expenditure are not allowed in PGBP. What about deductions? In chapter 6A deductions, that is chapter 6A deductions, what are not allowed? Other than these two, everything else is not allowed. 80C not allowed, 80D not allowed, 80DD, DDB, 80G, GG, GGB, whatever section you are talking, TTA, TTB, nothing is allowed. What is allowed? Only two, 80CCD2 and 80JJAA. So your employer contribution, National Pension Scheme employer contribution, that is 80CCD2, employer contribution. How much contribution? 14% in case of government employee, 10% in case of other employer. This alone, 14% in case of government employer, both central government and state government. State government is an amendment. 14% in case of 80CCD2 is allowed in case of government employer. 10% of salary in case of other employers is allowed under 80CCD2. There is no limit, only this is the limit. Additional employee cost, that is 30% for 3 years. So each year you claim 30%. So this is also allowed. This is also allowed under new regime. Other than these two, nothing is allowed. Nothing is allowed. What about carry forward loss? Unabsorbed depreciation loss on additional depreciation. So not generally unabsorbed depreciation. Unabsorbed depreciation on this, on this additional depreciation alone is not allowed. So not every depreciation loss, additional depreciation loss alone is not allowed. Unabsorbed depreciation because of additional depreciation, that alone cannot be carried forward. And loss from house property. Loss from house property can be self-occupied or let out property. Any loss from house property cannot be carried forward. So these are the things that we are talking about, which are not allowed under new regime. What is the tax rate in new regime? For every 2.5 lakhs, increase of 5%. So 0 to 2.5, no tax. 2.5 to 5, 5%. 5 to 7.5, 10%. So then go on up to 15 lakhs. Then after 15 lakhs, it is 30%. So you go up to 30%. After that, it is uniform 30%. So this one single slide will tell you what is allowed under section 115 BAC, what is not allowed under 115 BAC. So I have clearly told you these X and except are allowed. X and except are allowed. Everything else discussed here is not allowed. Everything else is not allowed. Please be very clear, because some of your 14 questions will request you to calculate both tax under the old regime, tax under the new regime, and then finally calculate which is beneficial. As I told you, if you are into business, opting for 115 BAC is one-time opportunity. If you opt in, you cannot opt out. Once you have opt out, you can never come back. So 115 BAC is a one-time opportunity to business people. For everyone else, it is yearly opportunity. Every year you can choose what to adopt. So this is what is called in the new regime 115 BAC. Okay. We'll move on and understand about the total computation of total income. So computation of this chapter 8 talks about your total income. So residential status, we already discussed. There are 3 types of residential status: RNOR, ROR, and non-resident. So first step is to identify residential status. Then what you do, you classify the income and compute. So each head, you have to calculate all 5 heads of income separately and see, then combine. After you calculate these 5 heads of income, if there is any clubbing of income, you have to put it into that. In case of clubbing of income, if it is salary, you also have to treat it as salary. You also will be eligible for standard deduction under section 16 for 50,000. If it is house property, it's what is being clubbed. You will also be eligible for 30% standard deduction. So when you say clubbing, it has to be clubbed under respective head. You will also be eligible for respective deductions and allowances. And then after clubbing of income, you will actually adjust for losses. That is, any set off or carry forward losses will be adjusted. Any set off or carry forward losses will be adjusted. So that is what you have to do after this club losses. So current year losses and any carry forward losses needs to be adjusted. On this income, you arrive at gross total income. Based on this, you arrive at gross total income. From gross total income, you will apply deductions under Chapter 6A. You will apply deductions under Chapter 6A from 80C to 80 RRB or something, 80 TTB, 80U. All these deductions you can claim. You will be claiming it. After applying deductions, you will get the total income. You will get the total income. On that, you will apply the tax rates. You will apply the tax rates. When calculating tax rate, you will also see whether rebate is applicable. Rebate is applicable up to 5 lakhs of 100% of tax. So, and we also said it is not applicable for 112A income. It is not applicable for income earned under section 112A. You apply health and education as 4%. Then you calculate alternate minimum tax 115 JC. Then you see if there is any income that is taxable at concessional rate, that is low rate. So what you do, you calculate income under section 115 BAC. So you check whether new regime tax is beneficial for you or not. If new regime tax is beneficial for you, you adopt that. If you are non-business, if it is not, you go by the old regime. Now, after adopting this concessional rate, you apply, you adjust whatever is the tax credit, whatever is advanced tax TDS. So you all these three are basically adjusted. Finally, you arrive at tax payable or refundable. This tax payable or refundable, whatever is tax payable or refundable needs to be paid. So you have your tax, add surcharge, okay, less rebate if any. Then on that money, you add what? You add cess, right? You add cess, you get a number. So on this, you reduce. So this becomes your tax. On this, you reduce TDS, TCS, advanced tax. So you reduce all these three, and then you get your final payable. Now this payable will be paid under section called 140A. 140A is called self-assessment tax. So the self-assessment tax will be all the taxes plus any interest under section 234A, B, C, or F, or fee under section 234, whatever it is. So all this only will be paid under section 140A. So this 140A will give you a complete picture as to what your total tax is all about. So this is about your total calculation. With respect to examination perspective, as we have been talking about various sections, I'll just highlight the importance. So far in this provision, we discussed about various clubbing and everything. Since we have some time here, what I will do is I will highlight the important TDS section. So for ATC, LIC is important. So LIC is important, will be commonly tested. And out of this, I only considered what is commonly tested in all these sections. The ATC is generally questioned. Whatever I've given here is a commonly tested question in ATC. So apart from this, being questioned on ATC will be a very rare scenario. And whatever has been discussed here in these two slides in ATC is important. 80 CCC and 80 CCD. CCD is something which is tested. This will not be tested. 80 CCD will be tested. You have to know there is also an amendment of the state government. So it is important for you to understand that it is also applicable for state government employee. And then, of course, this limit is common. 80D is important. So you will also be questioned on 80D as such. So 80D is also common. And 80DD and 80DDB, 80DD and DDB is a rare thing. Since 80D has an amendment about the 60 years, there is a possibility that will be questioned. The amendment says that earlier it said that if annuity is received on individual's death, it becomes taxable. It becomes exempt. Now they have included death or becoming senior citizen. So individual death or becoming senior citizen. And they said that if the disabled person predecessors, it is generally taxable. Now they have added, they said that it is not taxable. If it is not taxable, if that corresponding individual has crossed 60 years. So these two are amendment. There is a very high possibility that you will be tested on this. 80U is also similar. Since it is self, all these conditions will not apply. Just eligible expenses will be applied. Deduction of this 80,000 and 1,25,000 will be applicable for 80U. So 80U only this will be applicable. 80DDB is not that common. It's not a common provision. 80E, 80E and all is not common. EEA, the period is over. 31st March 22 was the last period. It is not applicable afterwards. So it is not applicable for financial year 22-23. But if the question says that the loan was sanctioned during that period, then it is eligible. So you have to be slightly careful with respect to applicability of 80EA. It is not applicable for loan sanction for your exam year. That is 1st April 22 to 31st March 23. It is not applicable. However, 80EB is applicable. 80G, you will not be tested much. You will be only tested on with qualified limit. With qualified limit only, generally you will be tested. And most of the time, your donation will be less than the qualifying limit only. So you will not be tested based on the restrictions of deductions. So most of time you will be tested on with qualifying limit only. But you have to remember, you will not be given a situation where your amount, your donation amount is higher than the qualifying limit. You will not have that situation. It's a very rare situation. And then 80GG and all, it will not be asked. 80GGC, 80GGC might be asked, might be questioned in PGBP problems. And 80JJA is also a very rare question. Even if it is questioned, it will be a separate question. It will be a separate question on 80JJA. It will not be a common question. This is very rare. Sometimes this pattern comes. This 80 RRB sometimes comes. Otherwise, this 80 RRB also comes in your scope of total income. They'll tell you that royalty is given. You have to understand in royalty, 3 lakhs should be reduced. In scope of total income problem, they'll tell you that royalty received for 5 lakhs, who was the first inventor. Now, when you are calculating scope of total income, you should not take 5 lakhs. You should only take 2 lakhs because 5 lakhs minus 3 lakhs. So you have to be careful while doing that, this income. So that is all about thing. And with respect to TDS, I told you that dividend is important because sometimes question will talk about net. The question that we discussed last time will be important. So that is also critical. 194A will also be tested on the net and gross. This is a very rare situation. You might be tested sometimes, not much. 194C, I already told you it is important. Please remember there are 2 rates, individual and HUF, and the limits are different per bill aggregate. So please keep that in mind. So, and how far you'll be tested on this exclusion? This exclusion, that is purchase from related party, you might be tested because it's a very recent amendment. It is only less than 2 years. So it's a very recent amendment. It was only introduced, I think, in Finance Act 20 or 21 only. So basically, this becomes important. So you can keep this in mind, 194C. And you can keep this matrix also in mind. So the slide, whatever I've written here, see it here because it will not be there in the slide. D, D and all is not important. H is sometimes you might be questioned, rare only. 194I is a common thing. 194I is a common thing. Just for you to remember that there is a separate limit. The limit is common for both plant and machinery and other things. So you have to keep that in mind. 194IA, you will not be tested much. 194IB, sometimes, yeah, they are testing you on 194IB, basically in MCQ or something, they are testing you. 194J is important. You will have questions. And as I told you, there is no limit for BA. Everything else has a limit. Everything else has a limit. So that also you would have to keep in mind. 194M is it's new only, but it's like 3 years old or something. So basically, it's a very rare situation that you'll be tested on this also. 194N is very rare. E-commerce operator, yeah, you might be asked as a separate TDS question as to what will be the TDS implication. So your question on TDS alone will be TDS implication. What will be the TDS implication? There is a possibility that this question might come under that. And 194P, being individual is the primary importance of your intermediate syllabus. there is a possibility that 194P will also be tested, but it's a rare situation only. Q, no, very rare possibility. Q will not be tested. R, considering that it's a very new provision, yes, it's a possibility. Please remember the limit of 20,000, the rate of 10,000. For all these provision, please remember the rate and the limit is very important. And of course, exclusion and all is important, but more important is rate and the limit. Know the rate, know the limit, and that becomes very critical. For 206A and AB, you will not be asked any separate question. But as I told you, in tedious implications, you might have to write along with 206A and 206AB. So please understand the conditions for 206AB. 206A, there is no condition. It is just no PAN, that's all. But 206AB has 3 conditions. You are a resident, you have not filed a return, and your TDS and TCS is more than 50,000 in each of these 2 years. So please keep that in mind. And I also told you that it is not applicable. The ones highlighted in blue is a new amendment. So 206 AB is also not applicable for these sections. So this is what becomes important. And in return filing, I told you that these are all new additions. So you might have a question based on this, telling that the individual wants to know whether return needs to be filed or not, and they'll give you some information. You have to pick the turnover of a business or a profession, see how much is TDS, TCS, and savings bank account deposits. So based on that, so this might also be a question there. 234 A, F and all, you will not be tested. Question on alternate minimum tax is also rare. So it's rare. So it's not a commonly tested thing. And 115 BAC, of course, it's very important. And moreover, from this year, this 115 BAC is taking a complete transformation. Everything is changing relating to 115 BAC. So since this is going to be the last time this 115 BAC has this type of approach, basically what will happen is you might have to know these concepts of 115 BAC, what is applicable and what is not applicable. So that is also important. And of course, this is the entire intermediate syllabus. Whatever we have discussed over the last 3 days is from residential status to tax payable and refundable. Apart from this, what I've only not covered the exempt income as it is. So exempt income, you have agri income as one chapter. For agri income as one chapter, it is applicable if your agri income is more than 5,000 per year. Agri code more than 5,000 per year, and your income from other heads is more than basic exemption limit. Only then the agriculture income needs to be considered. Agriculture income is not straight away exempt. There is a calculation method, but how far you will be tested on the calculation methodology is very rare. So basically, you should know there must be an agriculture income and that will be exempt. Agriculture income will be from a land, and you need not be the owner. Owner not required. So it must be from the land. That's what it's there. Or it must be from process or sale of such products. Whatever is coming from the land is processed and then sold. So that process is also covered. Or building income in the vicinity of the land. So this is also called. When you say vicinity of the land, basically they are talking about what type of land. What land will be called as agriculture land. So basically agriculture land will be covered based on your land area population. So what type of land is agriculture land? Population is less than 10,000. That is covered. So population is less than 10,000. If land is situated in an area where population is less than 10,000, it is covered. If a population is between 10,000 to 1 lakh, the population is between 10,000 to 1 lakh, the distance should be more than 2 kilometers. If it is 1 lakh to 10 lakh, the distance should be more than 6 kilometers. If it is more than 10 lakh, it should be more than 8 kilometers. Please remember, I am telling you the positive condition. In your study material, what you will have is a negative condition. Whatever you have, whatever I've been telling you for calculation of agriculture income is based on your positive condition. These are basically your positive condition. That is what is called as an agriculture land. In your book, you will have negative condition, reverse of this. So please understand that. Don't tell me that I'm telling you something wrong. Whatever I'm telling you is correct. I'm just telling you it in the positive manner. Steady material will have a negative condition. So that is what, so income from such land, income from such building in such land is what you called as agriculture income. Apart from that, whatever is relevant exempt income we have covered. Another exempt income of SEZ, I told you, it is eligible for SEZ business set up in SEZ. Eligibility is for 15 years. Eligibility is for 15 years, where it will be split into 5, 5, and 5. First 5 years, it is 100%. Next 5 years, it is 50%. Next 5 years, it is 50% or amount credited to SEZ reinvestment reserve account. So whatever is coming into this will be eligible for the last 5 years. And what is eligible? Your export turnover. Profit on export turnover. So how do you determine? Total profit into export turnover divided by total turnover. So for total turnover, this much is the profit. How much is for export turnover? So this amount only is 150 or this. So that is basically exempt. So that is section 10AA. So this is also another section. Probably I did not have a separate slide for that, but this is what is applicable. So I had kept for last 15 minutes to capture any areas that I've left out here or talk about it. Okay, I think that's all the topics that I wanted to cover. Few more things that I wanted to cover during this session is typically, basically, in the examination, there are certain things that are very critical. First and foremost is section. Okay, whether you should write the section numbers or not. Section numbers adds value, but do not write wrong section numbers. It reduces value. Not writing section number will not reduce any marks for you. But please remember, writing wrong section will give you marks. So keep in mind, have confidence in writing the section numbers. Remember the important sections. Whatever we have covered so far, we have specified what is important. And we've also given some tips to remember how to remember the section. So based on that, probably you can remember these section numbers. So it becomes important. And then the next important thing is notes. According to me, notes is the method that you communicate. You communicate to valuer, to the valuer. So valuer do not know who the person, who the student is, how is he good, is he bad, is he great? So valuer do not know. As far as income tax is concerned, how will the valuer understand whether you have known something or not? It's based on notes. So for every problem, for example, it is computation problem, write computation of X for assessment year 2023, 24. And always have particulars as first column, have a reference column, have couple of amount column, So it becomes very critical. So I'll have this as my model. So what happens automatically when I write anything, whether it is required or not, write a note number and explain that. Why are you allowing? Why are you not allowing? Whatever it is, however simple it is, however easy it is, you might think that everyone in the world will know this provision. But still write a note and say that this is why I've given that. Extra notes is not going to damage anything, but notes is very critical. Your assumptions, income tax lies on assumptions. For example, we spoke about indexation. We said your indexation for previous owner is valid only when you write the case law Manjula Jesha. So when you don't write this Manjula Jesha of Bombay High Court's ruling, you don't get the marks. Even your answer is correct, you don't get the marks because there is an assumption that you need to make there. So notes are very, very critical. Wherever you need to write the notes, please write the notes. And one more thing for the problems, markings, I'll call it as markings. So basically what I would suggest is in your question paper, in your P&L or whatever you're writing as it is you're writing in your question paper, basically there will be additions, adjustments. When you'll be given a P&L, and then some extra information. This extra information needs to be used for your calculating your income tax computation. So what you do is, if your book talks about something called P&L as a word called medical expenses. In pencil, you make a small mark to say that this needs to be added. This needs to be added. Why do you need add? This is not a eligible business expenditure. Medical expense is a personal expenditure. So you need to add, you need to dissolve. Under section 37, personal expenditure should not be considered as an expenditure. So you need to add. I will also do another minus. Why is this minus for? I am going to tell myself when I'm reading the question that I need to claim this as, I am a senior citizen. So I need to claim this as a deduction under section 80D. So medical expenditure is allowed when I don't have an insurance. So in 80D, I need to write. Now, does the question say whether you have an insurance or not? What do? You claim 80D and write a note saying that it is assumed that this person does not have an insurance. So everything is critical in income tax problem, your notes. So this markings will help you not miss anything in the question paper. When you're writing an answer, it will help you not miss anything when you're solving a question. Markings are not allowed in your question paper, but what I'm trying to tell you is make a small marking in pencil just for the purpose of supporting your solution. So this will give you an extra grip, an extra hand saying that you have not missed anything. Moment you have completed a particular step, strike off to say that you have considered everything. So once you have striked off every your marking, which means you have completed your problem. And only by doing this, you will be able to have a complete, overall solution, a complete solution, only when you follow these three things. As I told you, these three things are important: section, notes, and markings. So this is my own way of telling you how to make your paper better, make your presentation better. So this is what I follow. Have a fixed format. Apart from this, as far as theory question goes, so we'll leave this. Apart from this, as far as theory question goes, depending upon the marks, whether it is 4 marks, 6 marks, or what type of mark, you need to choose how to capture. Basically, your theory question should have 3 elements. One is provision. Another is fact. Another is conclusion. So your theory should have these 3 elements. What is the provision? What is the current scenario? What is the current scenario? What is the conclusion? What am I concluding? So your theory question should have these 3 elements. But when your theory question itself is only for 2 marks, not 4 marks or something, if you are going to write 3 paras, one for provision, one for fact, one for conclusion, it's going to take a lot of time. So in such cases, what do? You try to combine the provision and the conclusion. So simply write a fact in one line, then directly write the conclusion, which will also have the provision in it. So that will make the answer crisp and clear, so that you don't waste time. At the same time, you make it very clear, make it a very presentable manner. So theory might be a 4 mark or 2 mark question. Please understand there are 3 elements in a theory question. You have to give the provision, you have to give the fact, and you have to give the conclusion. When the mark is low, you combine these. And whenever you are going through a question, take time in reading the question. Because there will be very minute information. Each word might attribute for solution, for solving the problem. So each word might be attributing to the solution, or sometimes might be for confusing. For example, non-resident aged 65 years old. So your question will say, X is a non-resident aged 65 years old. Now tell me, is the age relevant? 65 years. You should not get carried away and say, since he's a senior citizen, I will give 80 TTB, 50,000. So 80 TTB, we said it's for senior citizens alone, that is 50,000. But when you're a non-resident aged 65 years, are you a senior citizen? No, you are not a senior citizen. So that 65 years is confusing. So pick the words when you're reading through the question, pick the words which is required, which is not required. So pick the words and accordingly start answering. So this is what will be my overall recommendation for income tax examination also whole, for theory problem, for solutions and all these things. my approach will be on these lines. So as I told you, please remember 3 points. Sections, don't get confused. Don't write wrongly. Make sure you're writing the right sections. Please find a way to remember the section numbers. Notes is the most important thing in income tax paper. Make sure you are writing the notes very clearly, because that's the way you are communicating to the valuer that I'm not chumma writing, I know the provision and I'm writing. So that's important. And the third thing is try to keep small markings in your question paper so that you make a mark, then you strike off onto what you need to do. So this is what is important. When it comes to theory, 3 elements are critical: provision, fact, and conclusion. Keep that in mind. And when you read through the question, certain words attribute to the solution, certain words confuse you. Pick the words that attribute and don't get carried away by the word that confuses you. So with all these things, I think I've concluded everything about what I needed to share over these last 9 hours. And I know I'm not given any break, nothing. And I've been just going on because I know it's YouTube. You can always go back and later take a break and start watching it again. So that's the reason why I also did not take much breaks. I also did not give you break. So wishing you all the best for a great examination this November. I'm sure all of you are going to rock the examination. See you all in the final of CA examination. So wishing you all the best. And with this, I'll wind up my session. Thank you all for the wonderful time.
Thank you so much, sir. Thank you so much. Thank you for your teaching. It was a wonderful sections throughout all 3 sections.
Yeah.
Hope the students have understood it. Thank you so much, sir.
Yeah, hopefully. Yeah, thank you.
Can I close the live?
Yeah. Thank you. Thanks for the time. Yeah.
Thank you, sir.